I'll give you. You like to sit right? Yeah, gotcha. No, thanks for your time. Hello, happy Friday. Everybody loves Friday. Some say today might even be better than yesterday. Let's see if we can do it. Another day of tokenization, everybody. Thank you again for coming out. Seriously, you all helped make this happen so we can do it again next year. But meanwhile, we've got an incredible day ahead. Franklin Templeton, DTCC, Northern Trust, JP Morgan, Broadridge, some of the biggest names in finance are here. Trillions of dollars, folks. I am so excited. I want to hear what they have to say. But man, I have a really good friend I get to introduce you to. His name is Carlos Domingo, the CEO of TokenizeThis. Come on out. Thanks. How are you today, Carlos? Oh.
Good morning, everybody. And thanks, Herwig, for the invitation.
Thank you, Carlos, for being here. You're a pretty popular guy right now. Well, first of all,
always been popular.
Well, I can say, as I have said, I've known him for a very long time. I've been a fan for a very long time. First, some of you may not actually know the real you. Just give us the quick story.
Wow. There's a long story because I'm also already pretty old, as you can see. So I'm originally from Spain, from Barcelona. My background is tech. I have a PhD in computer science. I've been in tech all my career, except for the last few years, which I'm in kind of in the intersection between tech and finance, I guess. And yeah, live in many different countries, in Japan many years, in Dubai before moving here to Miami, lived in the West Coast before, and hearing after all the excitement of the iPhone coming up and all the things that could happen, the telcos really didn't kind of like capitalize on that opportunity, and all the interesting things move away from a telecommunications company. So I was kind of looking at what to do next, and at that time, fintech was starting or was becoming a thing. And simultaneously in 2016, I stumbled upon blockchain with the launch of Ethereum and all the activity around ICOs, etc. And I started investing in some of the ICOs, and it was very interesting because as somebody from the tech industry, I have been basically investing on startups, investing in funds to get exposure to the tech industry all my career, and there was always two things that were very problematic. One is how complicated it was to get the investment done, and how cumbersome, and discover the opportunities, get access to them, etc. And second, once you've got there, the investments were completely liquid, and that was a big problem, right? Because not everybody has money that you can park somewhere for like 7 to 10 years. I've actually have some funds that have invested a long time ago that they've started like doing distributions now after like 7 years or 8 years, and you still haven't even recouped the principal. So I always thought that these two problems, the ICOs, to some extent, they solved that, right? Like it was very easy to invest back then. These days it's a bit more cumbersome, but back then you just connect your wallets and ETH, receive a token, and suddenly you have a token that represents some sort of economic interest in the project, and then it got listed in Binance, and then you could trade it right after, so it was liquid. So I thought, well, this is super cool. Why don't I do this with startups or funds, right? Because those are like the natural asset classes that you want to make it accessible to people, and you want to make them liquid. What I didn't know was the kind of regulatory complexity, because those things obviously are securities. Well, it turns out that a lot of the ICOs were securities as well, but that's, in retrospective, something that people find out later. And I had, as I mentioned, my background is tech, so I had no idea about how to do it, but if you want a bit of a naive way, I thought like, well, people trade stocks all the time, right? I remember opening my E-Trade account when electronic trading became a thing, and you could actually buy stocks from your computer screen in a very simple way and trade them. So I just felt like this technology could actually enable to do that in a simple way, and the fact that it's regulated shouldn't be a barrier of entry. So that's how we decided then to tokenize a fund, and the fund is called Spice VC, and we did it. It was very small at that time, but it was one of the first projects, tokenization projects in the industry. It was probably the first fully tokenized fund. So yeah, very exciting. That's when I met you guys here in Miami and eventually moved here. So.
And that's right around 2017, 2018, a very different environment that we see today. But TokenizeThis was born. The name is pretty on the nose. If you're not familiar with what they do, just go check out their website. But of course, you guys are the tokenization leader today. It was a very different landscape in 2018. Tell us what's different from then versus today.
Well, there's a lot of things that are similar, like conferences like this existed back then, and then they die, and then now they reappear, that there's conference dedicated to tokenization, or what now the crypto people call real world assets. So 2018 was kind of like similar in that respect. The concept of tokenization was kind of born at that time, and there was a lot of excitement about basically bringing financial services products on chain to make them more productive. I think what was different is that in 2018, none of the companies playing in the space had licenses. That was the process of like getting the licenses and going and talking to the SEC, etc. I will say the infrastructure was very immature. If I look at how we do things now with, I don't know, we use, for instance, Fireblocks, and it's like super streamlined to be able to approve transactions and issue tokens and things like that. Back then, it was very, very cumbersome. So I think infrastructure-wise, the industry has improved. And then I think that the financial services companies have also kind of matured into the space, which back then, 2018, the word token had a very negative connotation. I remember walking into some meetings, and the moment you say you do tokens, they are like, oh, this is a scam for sure, because otherwise you wouldn't be using blockchain, because that's what a lot of people did with the ICOs and everything. I think the last thing that has changed is that the people in the crypto space were really not interested about doing real stuff, right? So this concept of real world assets, which is a terrible name, But at the same time, it actually is, it tells you a lot that the crypto people call this real, as opposed to what has happened in the last few years, which is not really real. There was like issuing imaginary internet money and trying to speculate with that. So the crypto people really had no interest about the space. They went in completely different directions, ICOs, then initial exchange offerings, then governance tokens, then NFTs and whatever. So I think it now feels like it's a confluence of things happening. Crypto people wanting to do things that are real and that are productive, financial service institutions coming into the space. You mentioned some of the ones that are active in the space, which is, that definitely didn't happen in 2018. And then service providers like us having the necessary licenses to be able to work with those financial institutions and give them kind of peace of mind that what we do is legal and is regulated and is safe.
It's a little bit more complex, folks, than just saying the term licenses. I'm going to just make you rattle down the list of all the different licenses and divisions that Securitize has.
So the first license we got is something called a transfer agent, which, to be honest, just to be transparent, when I heard the term transfer agent in 2018, I had no idea what a transfer agent was. I was actually...
Nobody did.
Accustomed, well, I guess people in finance knew, right? Like, as I say, my background is tech, right? So I actually had an account with ComputerShare, and I didn't even know that I was actually using a transfer agent service. So actually, Juan Hernandez, which you remember him, he's the guy that educated me on that. He was the founder and CEO of Open Finance Network. And that's when we kind of started studying what a transfer agent is and what role it plays in traditional finance, and kind of realized that, you know, when you securitize an asset and tokenize it, basically issue shares on a public distributed ledger, you're effectively acting as a transfer agent, and therefore, you know, getting that license was what it was required to be able to work in a regulated way, tokenizing stuff. So we hired our first general counsel in January 2019, approached the SEC, started talking to them. Those days, the knowledge they had about the space was very, very, very limited as opposed to now. But you know, eventually we got the registration done, and that was the first license that we got. So a digital transfer agent if you want. There's been many others in the industry after that. I think today it's safe to say we're the largest one, and this is actually public information because we have to file with the SEC, public filings about our metrics. So that was kind of like the first license. Then, you know, okay, fine. So now we can issue securities on chain in a regulated way. Great. So now somebody has to sell them, right? And somebody needs to trade them. So there was a lot of companies in the space, again, 2018, 2019, that started getting broker-dealer licenses or alternative trading systems, which are licenses that allow you to do secondary market trading for securities. And we started like working with them without having our own licenses. And by 2020, it was very clear that, you know, that was not happening. They were not taking off. They were not, you know, getting things done, etc. So at that point, we decided that we wanted to have those licenses ourselves and provide an end-to-end service. So we got a broker-dealer, we got an ATS, spent a year and a half with the SEC getting everything approved for being able to do tokenization and issue tokens that represent securities and trade them and settle on chain and all these things. And then the final one that we've got much more recently is an exchange investor advisor. So for some of the asset managers we work with, we actually act as their feeder fund manager for their funds, and that requires this other license. So those are the four we have today.
It's not an easy feat to accomplish because you also have to get the right language in order to trade digital securities in these types of products. Is there anything on the roadmap you can quickly share?
Well, look, so what most people don't understand is when you hear somebody say, oh, I have a broker-dealer or I have an ATS, that doesn't really mean anything unless you know what they're approved for. So these licenses are not standard that everybody can do the same thing, right? So every license has their own, quirks of like exactly what you've been approved for and how you can operate the license. So every time you want to do something different, you want to, settle a trade in a different way with using a different technology, or you want to, sell a new type of security, etc., then that requires an upgrade, if you want, of your licenses. And we've been doing that all the time. So we've been, getting, approval for 40 Act funds, and which we didn't have before, approval for, shares of bankruptcy companies, which was a popular thing a couple of years ago with all the bankruptcies happening on crypto and things of that nature. So we are continuing constantly trying to upgrade the licenses. And one of the things that we've been looking at is this whole custody problem of the digital asset securities, which there's a license called the special purpose broker-dealer, which is supposed to solve that. So that's those are the things that we're looking at.
So let's get to what I'm sure everybody wants to hear about. You did something I think everybody in the industry celebrates, which is the largest asset manager in the world has ended up working with you guys in order to tokenize a fund, right? And that's monumental because everybody listens and pays attention. It validates a lot for the industry. Tell us a little bit about BUIDL and tell us a little bit about just exactly your plans in terms of TokenizeThis capabilities, featuring what you're doing for BlackRock.
Well, so you probably have seen Larry Fink on TV, like a year ago in CNBC and many other forums talking about tokenization. When I first heard that, I thought, like, this is great, right? Because this is one of the most influential CEOs. He's not just the CEO of the largest asset manager, but he's very influential. He's on TV all the time. He writes this annual shareholder letter that everybody reads, etc. So when he started talking about that, I thought, like, this is great, right? Because these guys are eventually going to do something, otherwise the CEO doesn't go on TV talking about it. And this is going to validate the industry, because what you need in the industry is credibility from the big players coming into the industry and doing something else. So we've been fortunate enough to be chosen as their partner, which is something I wouldn't think about it like 2 or 3 years ago that was going to happen. And very recently we've issued the first fund with them. Is a fully on-chain tokenized money market fund. Is managed by BlackRock, so we act as the transfer agent, tokenization platform, and placement agent with our broker-dealer. But the fund is a native BlackRock fund, which is an important distinction. So because there's no counterparty risk towards anybody in the industry, or us or anybody else. And it's fully on-chain, which is another great thing, right? It's issued on the public Ethereum blockchain. You have to hold tokens if you want to have units of the fund. We issue dividends on chain, for the accrued interest of the fund towards the wallets that hold the tokens. We have worked out with Circle an instant USDC redemption, so you can move your tokens that represent the units of the fund into USDC, which is tokenized cash, instantly on chain, etc. And look, in 40 days after launching, became the largest fund in the industry and the largest tokenized fund in history. So I think it's great.
You can always check the price at stm.co. I think it was, you may know the exact number of days, around 40 days to become the largest tokenized fund in the world. Was it 40 days?
It was 40 days from launch, but because we're still kind of bridging TradFi with crypto, we don't issue tokens every day. We only issue tokens the days that markets are open, because when we issue tokens that are securities, they need to basically deploy the capital into actual treasuries, which are not available 24/7. So yeah, it was 40 days. 40 natural days, probably around like 30 business days. So.
We can keep them honest. It's on the blockchain. So BUIDL is already attracting a lot of interest. Tell us again, we're talking about the future of finance. You have basically gone and created a new system, infrastructure for asset managers to come and build on. Tell us about the future plans for BUIDL. I know you have mentioned before you're looking at, it is on Ethereum, folks, if we didn't clarify that. So BUIDL is on Ethereum. Are there plans for other blockchain support? What's going on?
Look, the same way that you have USDC in many chains, the natural thing to do will be to have BUIDL in many chains. For the time we started with the public Ethereum blockchain, I guess that's the safest place to start if you want from a longevity perspective. They've been around longer than anybody else. They are the largest chain, the most liquid one, etc. But I think there's a lot of other interesting blockchains out there that contain other use cases, other ecosystems, etc. That it will be definitely interesting to be able to deploy the tokens there. As you know, we've done projects in the past with Avalanche, with Polygon, with XDC, etc. So that's obviously something we're looking at. In terms of use cases, we're kind of looking at like 3 different things, right? The first one is pure like on-chain native treasury management for companies. We've recently submitted a proposal to the Arbitrum Foundation, a governance proposal on-chain that we have to buy tokens to participate, etc. So very, very crypto native stuff to be able to start deploying Beetle as part of their treasury. The Arbitrum Foundation holds $6.5 billion in treasury, which is the second largest one in the crypto space, and they've started kind of diversifying a little bit of that into safer assets like a tokenized money market fund. So that's great, and some of the current Beetle holders are basically using it for treasury management. The second one is derivative products. So there's a lot of people in the industry building things on top of treasuries, on top of money market funds, but they didn't have a good access to the underlying because they didn't have like a good interface to interact with a fund because all those funds are not on chain. So now those funds are on chain, our fund is on chain, and therefore they can build other products. And I think it's already been announced that Ondo Finance is one of the companies that is building on top of Beetle. Mountain Protocol has announced it as well, and there's several others that you will see in the coming months. And the third one, which is very interesting as well, is in traditional finance, when you trade, you have to post collateral for margin, right? So you have a position open, and then you have to post collateral in case your position goes in the wrong way, and they need to liquidate it. You need to make sure that they have cash on the exchange to do it. That happens to me, for instance, in Robinhood when I trade options. That sometimes, depending which options strategies you do, they ask you to post cash to hold it there in case your strategy goes the wrong way. So in crypto, it's the same thing, with the main difference that crypto, because it's all on chain, it moves at very, very fast speed. So the collateral has to be on chain, has to be able to liquidate it on chain, move it on chain, etc. And this typically is done with either crypto assets like Bitcoin or ETH or stablecoins. And stablecoins are a very, very popular way of posting collateral in crypto exchanges or on private brokers. So now we have Beetle, which is cash equivalent. It's a money market fund that contains overnight repos and short-dated 3-month treasuries. So from a cash perspective, it's almost like cash, but it has a yield. It gives you the Fed rate, which is 5.3%. So instead of posting stable coins, you can now post Beetle as collateral, and the time the collateral is sitting on the prime broker on the exchange, you're actually earning a yield. So we have one partner, FalconX, which is one of the largest prime brokers that has already announced that they're taking Beetle as collateral, and we're working with many of the industry participants to be able to replicate the use case across the industry.
Now, which is incredible, by the way. It is truly a feat to build out the infrastructure, these partnerships, and the continued expansion. Speaking of expansion, BlackRock doubled down, and they invested in you guys alongside Hamilton Lane, another $1 trillion+ asset manager, alongside TradeWeb, and alongside a lot of Circle from behind USDC, alongside many other incredible investors. 47 million, I believe, was the exact number that was reported. What are you going to do with all that cash? Tell us about this round.
I'm going to spend it.
Oh, I hope so.
Look, we didn't need money, to be honest with you. We've always been pretty good at raising money and keeping money and being prudent with expenses. But there was this opportunity of BlackRock. Has become a very close partner, and I think we've become a very close partner of them because the amount of work we had to do as a company to be able to act as a provider for a company like BlackRock put us in a position that is very difficult for all the company to come and displace us there. And I think that they probably recognize the same thing, that they're with us for the long term, and then the natural thing was for them to become a shareholder of the company and being able to support us in a different way, right? Being able to have access to, help us with the strategy overall, being in the board. So Joseph Shalom, who is the head of global partnership for BlackRock, is taking a board seat, Securitize. And then since we're getting this round from BlackRock, we wanted to do if you want, more strategic round, like not just pure financial investors, but all the companies that we're working with, to create this ecosystem, right? So Hamilton Lane is a very close partner of us. We've been working with them for close to 3 years now. We've tokenized 3 funds. And then, when the opportunity to invest came through the BlackRock round, they participated as well. And then, TradeWeb, probably, I don't know, unless people are from traditional finance, you probably never heard of TradeWeb, but TradeWeb is a very, very large company. It's the largest fixed income trading company. They also, around 80% of the treasuries in the US are purchased through TradeWeb. They're obviously a very close partner of BlackRock as well. And they've been looking at the space for a while already. And when there was the opportunity to come and not just invest with us, but partner, and hopefully in the next few months you'll see some joint work with them. They also participated. And then, we had stablecoin providers, so Circle and Paxos. I've always explained this, but one of the things that tokenization brings is the ability to have on the same ledger the securities and the cash alongside, right? So if you think of what a stablecoin is, it's tokenized cash, and if you think about what we do, we tokenize securities, right? And then in traditional finance, those two things are sitting two different ledgers, and they have to coordinate to move, right? Like if you sell me shares, I need to send you cash, and those are two ledgers that need to be synchronized, and this is why there is settlement times that are long, there's counterparty risk, et cetera, and blockchain eliminates this thing, right, by having the two instruments in the same place. So the stablecoin providers for us, and by the way, going back to what didn't exist in 2018, stablecoins did not exist in 2018. At least not at scale like now. So both Circle and Paxos are leaders in stablecoin issuance. Circle with USDC, Paxos is behind, as you know, the PayPal stablecoin and some other projects. So they also came along in the round.
Yeah, obviously BUIDL is now the biggest product already. We're seeing this trend of what we call liquidity funds, liquidity products, building the foundation of the future of finance in order to be able to settle into instantly, in order to take advantage of blockchain natively. We need these products to build. So obviously that's fantastic. Is that going to be the focus for the next couple of quarters? What else is sort of that you can say you believe is going to help move the market forward, and maybe that you're able to say you're working on?
Obviously, we literally just launched, right? Like, so there is a long way to go to get this to be really a meaningful size asset. I know it's the largest one, but it's like around 400 million now. So there's a lot of room to grow this, and within the three use cases that I mentioned, treasury management, derivative products, and collateral management, there is still a lot of things that we could do. So we've just literally scratched the surface. There's a fire coming.
You're too hot right now, Carlos. I think, are we probably okay to keep going? Gonna maybe wait it out.
Yeah, in my building happens all the time. We never leave.
So,
Kyle is gonna pull the fire.
Kyle will fix the situation. Apologies for that, folks. I think we can bear through.
Okay, no, I don't know if we're gonna.
I hope there actually isn't an actual fire, though. So.
All right. So so in terms of plans, obviously we need to continue executing on this. This is literally launched very recently. So there's a lot of work that is happening to get this to be much bigger.
There has been a fire emergency reported in the building. Please evacuate the building by the nearest exit. Do not use the elevators.
All right, I don't know if we're going to be able to continue on this, but the other thing we're looking at is like, so BUIDL is native on chain, is in the public Ethereum blockchain, it has USDC instant redemptions, etc. But there is a whole lot of other stuff happening in crypto, in DeFi, in terms of lending and automated market making, etc. That is kind of like the natural next step for this type of products to start interacting with. Of course, there is one degree of challenge of these products. These protocols are all permissionless, anonymous. What we do are securities, which are permission and have to have a holder that who they are off chain, etc. But I think there's ways to kind of bridge those, kind of do the next gap that we can bridge, the same way that we bridge TradFi with crypto, real world assets with DeFi, and that's a very interesting area that we're now very closely looking at how we can do something there.
It's amazing. Now, on top of building a lot of infrastructure and a lot of great US clients, you guys actually have been in Japan for quite a while. You guys recently announced a product in Spain. You guys are clearly expanding globally. Tell us more about your plans and philosophy around that and sort of what's going on abroad.
So I don't know. I've always thought of our company as a global company. I'm based in the U.S., but I'm European. I live in Japan many years. That's why we have this connection there, and I have raised money from a lot of the top Japanese institutions. And
Please, there has been a fire emergency reported in the building. Please evacuate the building by the nearest exit.
I see still people running around out there checking.
yeah,
So
nobody seems to be leaving though. But so Japan is most people don't know here in the US what we do there, but we've actually been operating there for a few years now, 4 years. We've actually been very successful in terms of if you're in Japan, everybody knows TokenizeThis. We've done the biggest projects in the country with the biggest names there, whether it's Mizuho or Entity Data or Marui or many of the top companies there. And then in Europe, there's been crypto regulation coming into space recently. There's kind of three things happening. One is called MiCA, which is for digital assets. Then there's a stablecoin payments stablecoin bill coming up there. And then there's something else called the EU DLT pilot regime, which is basically regulation for tokenization, basically. How can you represent securities on chain, how you track them there, how you trade them, etc. So we've been applying to that license for a year now. Nobody has got it yet, so it's this kind of things that is a bit frustrating. That it takes very, very long time, but we hopefully think that we're going to get it and be able to kind of like replicate from a licensing perspective what we have in the US, but in Europe, which will give us additional flexibility, right? We do operate with European customers from the US, but it's limiting, right? So you can't do solicitation. You have to be very careful about, who you deal with, etc., because you don't have a local license. So hopefully being able to have licenses in Europe will allow us to do more things, not just sell to more investors, but also originate products from there, etc.
I, for one, am a big fan of these sandbox models that I wish actually the US would embrace, because it does allow companies to essentially act and operate with this new technology under and in cooperation with the regulators to make this technology work. Because again, globally, even regulators are paying attention to this. They recognize that, I even believe one day they will embrace this technology for its benefits and transparency and everything that's going on. We have 2 minutes left, Carlos. Anything you want to mention that you like to take, before we kind of move on here? Although we can take a couple extra.
I don't know. maybe it's just then me speaking again. If anybody has any question from the audience.
We do a quick question from the audience.
There's somebody there.
I can speak loudly, I guess.
Go for it.
So
I'll repeat it.
You had great success working with asset managers, Carlos. Any plans to work with actual enterprises and businesses who want to get onto blockchain?
So not just working with asset managers, but corporations and enterprises that want to get out of blockchain.
So I don't know when you mean enterprises that want to get onto blockchain, what they want to do, but certainly we're not interested in blockchain for supply chain management or for things like that. We're a company that it's called TokenizeThis because we securitize assets and put it on the blockchain and have licenses to work with securities on chain. And we want to focus on those use cases. We're not interested in doing something which is outside the scope of what our company has been created for.
Yeah, I was mentioning more corporate capital. So companies issue debt, corporate debt.
Debt.
Oh, well, so we've tokenized equity and debt for companies. Yeah, certainly. We did, the most successful tokenized equity product in the US so far, which was the Reggae Plus offering for Exodus Communications, which is a crypto wallet that they raised $75 million with a token that represents security. That is very interesting. TradeWeb, as I mentioned, is the largest fixed income trading platform, so they obviously have a massive book of business in terms of corporate bonds, etc. So yeah, definitely we're interested in that space as well.
We're going to take one or two more if we can do it. Anyone else got a question for Carlos?
I'm close to the mic here, Rob from Stellar. Do you see any angle where those assets could be traded on DeFi with some sort of KYC enforcement or integration with third-party platforms that might use you as the KYC enforcement layer?
I do, yeah. I think I have a good idea about how to do it. It's tricky. I think KYC is not the only problem. Like there's a misperception in the crypto industry that if you KYC, then everything is fine. Security is unfortunately a lot more complex than that. So there's a lot of other things that you need to take into account, which are not purely just, whitelisting wallets. But I do think that, those technologies are very valuable, and there's mechanisms to make them to be able to be used within the context of, securities on chain. And pretty convinced, and hopefully we'll see some of that coming in the second half of the year.
I'll do one more. We got one more here. Saw first go up over here.
Carlos, I'm curious if you could comment on why BlackRock chose to do really basically an institutional, non-40 Act structure and builder. We'll hear from Franklin Templeton and Wisdom Tree today have created a more retail product with the on-chain money fund and the digital trust. Was there an impediment, or did you think was the speed to market to go more of the institutional route?
So I can't speak on behalf of BlackRock. I work for TokenizeThis. Why they chose to do that project or not is not something that I can address. So, but I guess different asset managers have different strategies. BlackRock chose an institutional product. These qualified purchasers for crypto institutions is very crypto native, as opposed to some of those products that you mentioned that are not very crypto native because the token doesn't move or doesn't. You have to go through a specific app. It's not integrated with the rest of the ecosystem, etc. So I guess everybody has different strategies, and this is great because then it shows different use cases and different things that you can do with these products.
If one were to go ahead and actually leverage a 1940 Act structure, of course, TokenizeThis could support that, and would be no problem.
Yeah, so we are approved for doing 40 Act funds, closed-end 40 Act funds. We are now about to get approved, hopefully soon, for open-ended 40 Act funds. We actually do have an interval fund, which is registered as a 40 Act called ARCA, which was, I believe, the first one that was registered in the industry prior to the work of Wisdom Tree and Franklin Templeton, which is now, was where the transfer agent and the tokenization platform, they are listed in our broker-dealer. So we do both, and to be honest with you, we're a service provider, right? We're not an asset manager, so we don't tell the asset managers what they need to do. We obviously, have our opinion about these things, but it's ultimately their decision. So
no asset is safe. TokenizeThis is looking to tokenize it all. It looks like you guys are building a fantastic foundation for the industry to build on. I think everybody here is very thankful for your time here today. Carlos, it's always a pleasure to see you.
Thanks, everybody. Thanks, every week.
Apologies for the fire. We're going to get the next panel sorted here.
Number 3, I guess. This is the one. This is 3? Yeah, I guess that's the one you want.
That's it.
The mic.
Okay, perfect. Thanks. How you doing, Bob? Come on in. All right, so what I'll do is I'm going to come from the other side of the stage.
All right, everyone. That was a fantastic fireside chat. We'll be moving on to the next session here for Tokenize This 2024. This is the deep dive into Project Guardian. Slightly different format for this session. We'll be starting with a 10-minute presentation from Stephanie Locke from Onyx Digital Assets at JP Morgan, and then we'll be followed right into the panel. So without further ado, Stephanie Locke, everyone.
Perfect. Hello. Hi. Thank you so much for having me. Super excited to talk about all things Project Guardian. As Jason mentioned, I'm Stephanie Locke, and I'm a product manager on the Onyx Digital Assets team as part of Onyx by JP Morgan. So before the panelists join me on stage, I thought we'd give you some insights into Project Guardian, what we built, a little bit of the challenges that we were looking to solve. But before I do that, I wanted to give a bit of a background on who we are as Onyx by JP Morgan. So Onyx is JP Morgan's blockchain-focused business unit where we've been exploring and building products leveraging blockchain technology for the past 10 years. And as a result, we've solidified what we've been doing and have broken it down into 4 different focus areas. The first was Link. Link is our payments information network that's on-chain. The second is JPM Coin Systems, which is our on-chain cash solution that leverages blockchain demand deposit accounts. And then jumping over to Blockchain Launch. Blockchain Launch is our research and development arm for Onyx, focusing on all things Web3. So really looking at that 5 to 7 year horizon in terms of what's new, what's cool in this space. And then Onyx Digital Assets. So Onyx Digital Assets, or ODA, is our multi-asset tokenization platform that enables clients to unlock untapped utility in their financial assets. So ODA is a true unified ledger with tokenized assets and on-chain cash like JPM Coin on our platform. We are currently live with 3 applications where clients are actually moving and settling value, where to date we've actually settled over $1 trillion of notional volume. So the first application we went live with was digital financing. So digital financing is where borrowers are able to receive liquidity on an intraday basis and receive financing in exchange for collateral. The second application was Tokenized Collateral Network, or TCN, where users are able to tokenize and use assets as collateral. And finally, Digital Debt Service. So we actually just went live with Digital Debt Service just last week, where it facilitates the issuance, transfer, settlement, and automated servicing of debt securities. So those are our 3 live applications, but you'll see on the right side, these are some of our focus areas for ODA moving forward. So first, investment fund tokenization, which ties in very nicely to Project Guardian, which we'll cover. And then we're also looking at a few other use cases that we'll want to deploy on the ODA network. And finally, we're actually opening up ODA. So really looking to bring on third-party owned, third-party developed applications onto our platform. So with ODA's vision of unlocking untapped utility for the world's financial assets, we thought that Project Guardian would be an amazing opportunity to really look at what that future of fund tokenization really looks like. So many of you may have heard about Project Guardian, but at the end of last year, Onyx and Apollo co-led this initiative under the Monetary Authority of Singapore's Project Guardian initiative. We focused on the asset and wealth management industry and how we could transform the model portfolio space by leveraging smart contracts and tokenization. So we targeted the $5.5 trillion market in building discretionary portfolios for individual investors. So discretionary portfolios is essentially an investment solution that wealth management firms can offer their investors, where they can provide curated, personalized investment portfolios based on their financial goals and their risk appetite. Our goal for this project was really to enable a portfolio manager to seamlessly manage a large number of discretionary portfolios that includes both traditional assets and alternative investment funds that are tokenized on multiple blockchains. Now, we didn't just do this proof of concept just because we thought it'd be super cool to connect 3 different blockchain networks and tokenize some assets. We also saw some very real and material challenges in the asset and wealth management industry. So for many wealth firms, managing tens of thousands of portfolios for many investors at scale is extremely challenging and extremely inefficient. So ensuring these portfolios align to the investment allocation that is set out by the target model requires multiple parties, manual processes, and multi-party reconciliations. So this essentially means that adjusting it in a timely manner is extremely difficult, resulting in a suboptimal investor experience. In addition to that, we found that there's limited access to alternative investments like private equity and private credit. So gated by limited liquidity and greater operational challenges compared to traditional assets, alternative investments have really remained out of reach for the discretionary portfolio space, meaning that many investors are unable to tap into that higher performing products that like alternative investments. And finally, now we knew that blockchain technology in and of itself could really solve these 2 previously mentioned challenges. However, we recognize that while we solve those challenges, blockchain technology in and of itself also has a few pain points that wouldn't allow us to get to that future ideal state that we want to get to. So we really dove deeper and explored to solve a blockchain pain point, which is the fragmentation across different blockchain networks. This fragmentation really dilutes that original promise of having a shared ledger as the single source of truth. Now, the cool thing about this proof of concept was that we were able to see benefits from all angles. And so we validated this throughout the initiative. By enabling automatic rebalancing for portfolios at scale, we were able to take a process that currently is around over 3,000 steps and just brought it down to just a few clicks. And then in addition to that, by leveraging smart contracts for near instant settlement of buy and sell orders, we saw that there's a potential to eliminate cash drag from these discretionary portfolios. And estimated that to be around an annual savings of 18% or so. And then finally, with the harmonization of traditional assets and alternative investments, we found that tokenization could enable a $400 billion revenue opportunity annually for the asset management industry. So what do we actually do to get to these benefits? Well, we deployed a series of smart contracts onto the Onyx Digital Assets Network to help solve for some of these inefficiencies. And essentially, due to the programmable nature of these smart contracts, we were basically able to have these smart contracts talk to each other and automate much of the end-to-end investment and rebalancing flow. In addition to leveraging the smart contracts that you see on here, we also brought together a group of world-class asset managers and blockchain solution providers to bring together this end-to-end ecosystem. Apollo, JP Morgan Private Bank, and WisdomTree all provided test traditional and alternative investment funds to be tokenized. In order to show the disparate nature of having a multi-blockchain ecosystem, we had Onyx and Oasis Pro tokenize these funds onto 3 different permission blockchain networks: Onyx Digital Assets, a provenance permission zone, and a private Avalanche subnet. In order to really connect these networks, we then deployed 2 interoperability solutions, Axelar and Layer 0. And we also leveraged Biconomy's account abstraction solution to really show how we can make a seamless experience for the fund managers. And finally, we deployed discretionary portfolios on the Onyx Digital Assets Network for a variety of investors. These portfolio smart contracts track the investment positions of the investor's portfolio across all of these 3 chains. And so then we brought together one final piece, a fully automated rebalancing system called Crescendo. So Crescendo is essentially that culmination of the smart contracts that I mentioned, all of these asset managers and blockchain solution providers such that we can automatically adjust an investor's portfolio to remain in line with the target goals. So this was a really, really quick speed round through Project Guardian. If you want to learn more, you can definitely read our white paper that we wrote with Apollo on the Project Guardian initiative. And then also, if you want to learn more about alternative investment fund tokenization, we co-wrote a white paper with Bain & Company, so feel free to also scan that second QR code to learn more there. So before my other panelists join me on stage, I guess what's next for ODA? Well, as I previously mentioned, we are focused on investment fund tokenization. So with that, and with this learning from Project Guardian, from Crescendo, that's one of the areas that we're really trying to build up in. We see that as the first step in building this asset ecosystem. And so we're looking at really doing it in two ways. One, natively through our own capabilities. And second, as I mentioned, we're opening up ODA. So really looking to bring on third-party tokenization platforms to plug into the Onyx Digital Assets network. So if anyone wants to tokenize their assets on our chain, definitely let me know. We'd love to chat after this. But with that, I'll wrap up here and then I guess bring the other panelists on stage. Thanks.
Fantastic, fantastic. So if we can get the rest of our panelists out here, let's get started and dive a little deeper. Alrighty. So before we do the deep dive, why don't we start with some intros and maybe your role in the tokenization industry outside of Project Guardian, as Stephanie has already kind of shown us everyone's role in that.
I guess I could go again. I'm Stephanie. As I mentioned, I'm a product manager on the Onyx Digital Assets team. Onyx Digital Assets is a tokenization platform as part of Onyx by JP Morgan, so really focusing on tokenizing and issuing assets on-chain.
Hi, I'm Meredith Hannon. I'm head of business development for Wisdom Tree's digital assets business. As Steph mentioned, we have a full suite of tokenized products that I'm sure that we'll get into a little bit. But more broadly, Wisdom Tree is an over $100 billion ETF issuer, and now we are really focusing on the blockchain-enabled finance migration. We think that it's the next evolution in the best, most efficient wrappers for end investors. So looking forward to talking about that a little bit more, as well as our retail app that we actually just went live with almost nationally this week.
I'm Anthony Morrow, CEO of Provenance Blockchain Foundation and Provenance Blockchain Labs. We are a layer one blockchain built in the Cosmos ecosystem, founded by Mike Cagney Juno at Figure in 2018, and has since grown with Figure's help largely, but with others as well, to being the largest layer one public blockchain in the world as measured by real world assets. There's a $10.3 billion of RWA across credit, private company equity, and several other asset classes. And the Project Guardian was a big stamp of approval for us, and we were really happy to work on it.
Hi, I'm Bob Yospiel from Oasis Pro. Oasis Pro is an end-to-end digital asset solution. We have a primary issuance marketplace, a secondary trading platform, a transfer agent, a tokenization platform, and a few other products that are in development. We focus on providing infrastructure to large institutions such as JP Morgan and Apollo. We were thrilled to partner with them on the Project Guardian initiative. It's great to be here, and thanks for having me, Jason.
Thanks for coming on and sharing your insights, everyone. So, how did you guys choose each other? Are there certain differentiating factors that each of you possess or that you saw in each other to be included into this proof of concept? And how did you choose the specific blockchains as well?
Yeah, I think so. Onyx really led that choice in the partners. For us, working on Project Guardian was not only a way to show the future of fund tokenization, but also a way for us to really learn more about what's out here in the blockchain ecosystem. So we really wanted to work with blockchain networks that we've never worked with before, like Avalanche and Provenance, and then also wanted to work with both an EVM and a non-EVM network, so really trying to see what that world would look like with both of them. And then in addition to that, if we look at the interoperability solutions that we chose, we went with two different protocols. One that was more of a hub and spoke model, and then the other one was more of a point-to-point. So we used that as our chance to really analyze what are these different models, how do they work, and then of course partnered with different asset managers who provided both traditional and alternative investment funds. And then in terms of tokenization, we had Oasis Pro tokenize onto the non-EVM chain. So that helped in terms of seeing what is that world from different perspectives and different models and systems.
Makes sense to me. Makes sense to me.
I would add from the Wisdom Tree side, we were absolutely thrilled to be a part of this. Really for three reasons, though. If you think about strategically what Wisdom Tree is focused on, it's blockchain adoption and technology, which I mentioned before, but it's also fixed income and model portfolios. And so this proof of concept really brought all of those three strategic pillars that we're working on, both in traditional assets and in on-chain assets, together in one, and to really showcase the future of what this could look like and where we could move to going forward, which I thought was really exciting. And a big piece of our ethos as well is to focus on solutions to problems. And this is a great example of that, where if you've ever worked in an OCIO type or a model portfolio type of business, rebalancing is a huge pain point. It's a very manual process. There could be a lot of errors associated with it, especially if you have alternatives. So I just thought this was a great example to showcase how this could really impact, not only from a process perspective, but what it could mean for the end investor in terms of the types of assets that could be offered, maybe even cost down the line, but especially in efficiency internally.
So let's dive a little deeper into that. There's a great way to get alternatives, right, into model portfolios. Are there any specific alternative asset classes that you're seeing have a little bit more demand or be wanted to be included in model portfolios than others? And do some of those alternatives have more infrastructure than others?
Well, sure, I'll take that. I think there's definitely interest in, private funds, private credit funds, real estate funds, et cetera. I've heard several times over the past couple of days about how tokenization democratizes access to these alternative asset classes and opens up a new pool of investors for large fund managers. So they don't need to go to their typical institutions if Main Street investors have access to fractionalized shares in these funds. I think it levels the playing field, and as I mentioned, I think it gives access to these alternative assets that typically generate higher yields than these investors would be getting in a typical 401k plan or something like that.
Yeah, and just to add on to that, I think the way we've been seeing it is that they're more so focused on really diversifying the type of returns that you can include in model portfolios. So it's not necessarily, I guess, like, is there a specific alternative investment fund that we've particularly seen people talking about? But I think it's kind of like, how do we diversify the returns that we can provide? Because not all alternative investment funds are necessarily the right fit. Like, we're not going to tokenize every single thing if it doesn't make sense. And then in addition to that, like, if we think about alternative investment funds, one of the key pain points is the limited liquidity. And so the type of funds that would probably benefit the best or work the best are the ones that have more liquidity, so maybe a hedge fund structure or ones that you can kind of sell out of without being locked in.
Well, if it doesn't make money, it doesn't make sense. So, how do you, there's operational savings that you touched on during your presentation. I think one of them was 18%, right? How do you see the money from those operational savings, being reallocated? Is it, to provide further infrastructure or research? Is it passed on to the investors? Do we simply save the cash? How do you see that being reallocated?
Yeah, so from that specific point about the cash drag piece, where we think that there could be an annual savings of 18%, it's really thinking about it from a savings for the investor's perspective, right? They're able to actually invest that amount and get some benefits from it instead of it just sitting in their portfolio, not doing too much. So that's one way, like, it could benefit the investor. The other thing that we thought about is that not only is it like a cost saving, but you can use it to grow the pie, essentially. So that $400 billion revenue opportunity number that I mentioned, that's essentially, like, if you think about it, if we grow the amount of individual investors who are investing into alternative investments, the opportunity of revenue there just just grows. And if you think about the benefits to the other participants in the space, like the fund managers, the wealth managers, their assets under management also continually just increases. So I think there's a way to both benefit from those cost savings, but then use that as well to like grow the pie of opportunity.
Makes sense to me. Anyone else want to add any color there, or should we move on?
Yeah, I think not everything is a good use case in blockchain. So it's, tokenizing assets for the sake of tokenizing them isn't a good reason to do it. But if you can change processes, if you can reduce intermediation, if you can save money, if you can reduce time, it's certainly worthwhile. The big use case on Provenance is obviously what Figure has done with home equity line of credit and with mortgage. And in the process of issuing a home equity line of credit and then warehousing it and securitizing it, they've taken 150 basis points out of the process. A lot of it is audit expense and legal expense because it's a more efficient process, and the warehouse and the final ABS underwriters don't need to go back and re-audit something that has been audited once, been written to chain with an immutable proof that the audit is true and accurate and that nothing has changed. So there's dozens of offline documents. They write a hash to the chain. If the hash is still valid, you know the underlying documents are still valid. So that 150 basis points is a lot in a very thin margin business. If you have friends in the mortgage industry, they're happy to write you a mortgage. Nobody really wants to write you a HELOC because it's the same amount of work for a fraction of the assets that go into the end product. So Figure and its partners, which are almost all of the 20 largest mortgage originators in the US, have taken that 150 basis points out. They're keeping some of it for themselves, but they're also reducing rates to borrowers, which it does some inherent good. I don't think we're doing God's work up here with tokenization, but if you can save some money and put some money back in borrowers' pockets, it is a good thing.
I like it a lot. And actually, Meredith, I think this may be helpful, or just really anyone, but does this open the door for more people to have access for wealth management solutions, such as robo-advisors at lower minimums? How does Project Guardian kind of help envision that future?
Yeah, I would say just more broadly, I mean, we're obviously not an alternatives manager, but especially on the fixed income side and some of the work that we did here, I do think that it also, beyond just opening access, it can also create more personalization, which is really exciting too. So if you think about just in this test case, it's 1,000 model portfolios that are rebalanced. Think about if you could do 10,000 and 1,000 different variations of different types of allocations, different types of risk profiles, where today, most of the big wirehouses would have, 20 to 30 maybe at most, because again, it's so operationally complex in order to rebalance them. So I do think that beyond even just access, there's also a personalization element that I think is really exciting on what this could potentially mean. But to Anthony's point, that doesn't mean that necessarily everything should be tokenized. It needs to make sense for what the value is, but I do think that this is an example where this is an operational process that could be executed more efficiently, and that leads to cost savings, it leads to personalization, it also just leads to more opportunities from an investment selection perspective, which I do think is really exciting, but definitely more to come. This was step one before we reach that nirvana.
So what's the next step? Stephanie, now that Project Guardian is, or the project is complete, what else is Onyx Digital Assets focused on? What can we expect in the near future?
Yeah, I spoke about this a little bit, but I mentioned, Project Guardian was really that first step, as Meredith mentioned, right? And we want to see how we can take it forward. So investment fund tokenization is where we're really focusing a lot of our time in. And so we're working with fund manager, distributor, fund admin to really tokenize an alternative investment fund to see what that could look like. And that would be like that first step. And hopefully we get to that nirvana stage of crescendo. But for us, that's a very big focus area of how can we kind of productionize, industrialize what we built out as a proof of concept.
I would just jump in. To get to that nirvana it's a long process, right? In order to accomplish the goals of Project Guardian, you really need to have the fund manager be able to choose from hundreds or even thousands of available funds that are tokenized on blockchain, and we're obviously not anywhere near there yet. We've had some early and big successes. Hamilton Lane and Apollo and the BlackRock Bildl is, I think, a game changer for the industry because everyone was asking before, why should we tokenize a fund? What are the benefits? And it's hard to answer that question today if you are in a vacuum. To tokenize a fund either through a digital feeder or a digital twin is not really ideal from a cost or risk perspective in isolation. But if you can get 1,000 funds done, then you start to get into the ability to use them as collateral for cross-collateralization for other securities. You can lend against them, which is the absolute killer use case, and then maybe a secondary market develops as well. But put all those things in the mix with the ability to really finally blow up the 60-40 traditional investment portfolio and invest like the Yale University endowment on a person-by-person, separately managed account by separately managed account basis, you start to rewire finance. And I think we're going to see, certainly before my career is over, $700 trillion of financial assets come on various blockchains. It's inevitable. It's cheaper, faster, and safer. Just like when I started a long, long time ago, we were on Excel spreadsheets for cap tables, and now cap tables are in the cloud. It's the same evolution.
Very cool, very cool. Bob, Oasis Pro had a unique, role in this project. How are you guys looking to continue working with different, banks, asset managers, and so forth? What can we expect from Oasis Pro?
Well, just continuing on the comments from my other colleagues here, I think the momentum in tokenization around fund products since the Project Guardian announcement in November has really seen an acceleration to this space. We are talking to a number of huge money center banks that have not only a trading platform, but also asset management, wealth management businesses who are really tuned in on this. I have spent probably 10 years of my career managing fixed income trading technology businesses at Bank of America and the Royal Bank of Canada. When institutions like that are interested in this space and spending money to develop products and develop the technology necessary, it's certainly a good sign for what we're doing in the digital asset space.
Can you tell us a little bit about what we can currently find on Oasis Pro? I think you guys have a wine fund that you guys have recently tokenized.
Yeah, we have a tokenized fine wine fund of French wine from the Bordeaux region. You don't get to drink the tokens, it's an investment. Actually, some of these wine funds have typically generated an annual return of 15 to 18%, which is really interesting. This is a unique product that was brought to us by some former MakerDAO founders who have an interest in wine. We have that. It's going to be launched, I think, towards the end of May on the platform. We also have an ETH staking product called Methodic in Diamond Standard, which is a tokenized fund with underlying fine diamonds. We have a few other funds in the pipeline, so keep your eye out on social media for various announcements around that.
We'll definitely be keeping our eye on it for sure. Catch it on the Security Token Show. But, Anthony, you guys, Providence has largely been working with Figure. You alluded to it earlier. However, you guys have been very clear that you guys are very separate entities. So I do want to know, what can we expect in the near future in terms of working with multiple others in the space, and why should people look to work with Providence?
Good question. It sounds like it was teed up. So it's important to put Figure in perspective with the rest of the real world asset industry. So we just had our 1Q foundation call, and in the first quarter, Figure put $1 billion of HELOCs and mortgages on Providence. In digitally native, spun up, issued, ledgered, warehoused, and then put into rated ABSs and sold largely the TradFi way, but some DeFi as well. The entire tokenized treasury market is $1 billion, and it's been up for 3 or 4 years. So Figure's doing every quarter what the entire tokenized treasury market has done in its entire existence. And not to say that tokenized treasuries aren't good, I'm just trying to give some perspective on size. They keep us very busy is my point. There's a lot of stuff going on. But that being said, Apollo and Hamilton Lane and others have put assets on. We're working with a lot of other fund, particularly on the back of Project Guardian and the BlackRock announcement, other fund complexes coming on as well. And then lots of alternative assets as well. So I'm not sure if Cole Snell is in the room, but a company called Infinio is following the Figure playbook by putting digitally native whole life insurance tokens onto chain. They're going to Nice. They're gonna follow the Figure playbook. They're gonna warehouse them and they're securitize them. So replace HELOCs with whole life insurance. Great use case, right? Saves time, saves money, saves process, and you can really start to recreate asset classes if you're doing it the right way.
Makes sense. I'm excited to see all this, come live, and we'll be tracking it as well. Meredith, what is, you guys have 13 tokenized funds, is my understanding. What's the distribution process for you guys? How do you see, tokenization also, working into some operational side for WisdomTree?
Yeah, sure. And I think there's two sides of this in terms of opportunities. It's obviously from an operational process perspective, but then there's also the utility of these tokens. And I think what we're really excited about is the fact that when you put tokens on chain, that means a token that's a private equity token can sit beside an S&P 500, that can sit beside a gold token. So if you start to think about even trading, swaps, peer-to-peer transfers, but a big one is also spending. So how can you think about, instead of having to sell out of your brokerage account that you have to do today and wait 3 business days to then swipe your Visa, could you just swipe your Visa from your brokerage account and actually have that done seamlessly? So that's what we're building out through an app that I mentioned before, WisdomTree Prime. We did see that from a distribution perspective, there is friction in the process to come on chain today. And we think that, especially for retail consumers, that is just a barrier to entry. I think about anyone up here can, manage their own private keys in their own wallets and have no problem. But I think about anyone in my family who's not in finance, or even just people who want an easier experience. How do you think about just accessing your financial life on your phone, and how do you make it simpler? So what we did was built out an app that, if you're like me, you have a checking account, a savings account, a brokerage, a mortgage. I've got 12 different apps probably on my phone, which is probably why the thing's dead half the time. So putting that together in one app, and then being able to make that utilized in your daily life to be able to pay and send, and a lot more features coming on too. So like I mentioned, we have 13 blockchain-enabled funds. They're 40 Act. They're registered and regulated just like any of our other products. So really, really focused on security, really focused on regulation, and then it's just enabling those to be on chain to actually deliver that end value of being able to use your money more effectively, being able to be in the market, in a money market fund, earning 5% versus earning pretty much nothing in your checking account. That's really the ethos that we're going after here. And we think that from a distribution perspective, that's a huge need in the market and a problem to solve. So that's what's focused on from the retail side. We'll also be coming soon, launching an institutional platform as well to be able to access tokenized products too. So be on the lookout for more information on that in the next few months.
That is very exciting.
Yeah.
Full disclosure, I do have the WisdomTree Prime, and it is very smooth. I'm a big fan.
Thank you. We appreciate you. Thank you.
Okay, and can you expand a little bit on the recent news, you guys going more national and whatnot?
Oh, sure, yes. We got our New York Trust Charter license, which is a huge accomplishment. I'm sure as anyone in this room can appreciate working with regulators. So super excited there. And then we announced yesterday that we are also live in New York and 41 other states. So we cover about 75% of the country now in terms of the population. So you'll see a lot more in marketing and TV ads and all of that later this year. But we're really excited to bring this to market. And we do think, just considering we started this project many years ago, before 2022, 2023, with everyone here knows what happened in the news in terms of trust and counterparty risk. So we do think that there's definitely an opportunity for a trusted partner to launch a product like this, and we're hoping to be that.
So as you can all see, we have a great panel of people that really own their place in the space here. So shifting back to Project Guardian, right? Stephanie, you mentioned some of the future plans for ODA, but what do you see as some of the biggest obstacles in the near and long-term future?
Yeah, I think broadly we've all heard about the same challenges, that we need more standards, in order to make sure that these assets and tokens are portable, but also just for different chains to work with each other, right? So I think standards is a huge one. But I think where, it's a little bit less tangible that a lot of the folks here today are working towards is really proving that value add, right? We keep on doing all of these cool projects, and Carlos talked about the BIDL Fund, but I think all of these are really steps towards proving that value add. I think until we are able to prove that, it will be very hard to get the adoption that we want. And so I would say that's probably, in my mind, like one of the biggest obstacles and biggest challenges that we're going to need to continue building, continue proving out the use case, and continue proving out how much tokenization can provide operational efficiencies, cost savings, also just open up new opportunities for revenue. And I think that's one thing that many different players in the industry need to either work together to push this forward, or start just pushing their productionization and getting the word out there.
Anyone else want to volunteer some opinions on, what some of those obstacles would be? Any other obstacles, I guess?
I mean, I would add adoption for sure. To my point before, I mean, I think a big thing is, and to Anthony's point, you can tokenize anything, but if there's not a market for it and not a buyer for it, doesn't really matter. So I think that's a huge focus as an industry. And I think what's great is we all are coming together. And this is a great example of this, where all of the financial institutions that in traditional finance, we do this today, where we're counterparties to each other. We're starting to figure out ways that we can come together, and these are two great examples of actually how to do that from a technology perspective with Provenance and Oasis Pro, but how we can actually interact with each other, and so that liquidity is not so siloed, and we can actually make these transactions happen in the way that we need to from a regulated financial institution perspective, but then from a technology perspective, we can interact with other institutions that have different types of regulations or different types, whether they're on different chains or on different platforms. So I think we're moving in the right direction, but still a lot of work to do, obviously.
Yeah, and make no mistake, TradFi is entrenched, and they don't want to be disintermediated, full stop. And it's going to be a long road to get there. I have a friend who is in a top 10 asset manager, and he's in charge of blockchain, and he's a managing director and a pretty serious guy, and all the traders call him Bitcoin Boy. He doesn't like it. So yeah, there's people are going to be disintermediated, and a lot of revenue is going to come out of the financial system. So my old firm, BNY Mellon, has $4 billion a year in annual security servicing revenue that I think a lot of it goes away. So you either lead or you're consumed by it. And if you are neither, you try to make the inevitable last longer, at least until your career is over.
Yeah, and to that point, the adoption by large institutions, I think the technology teams understand the benefits, they understand the rewards that this technology offers. But in these large institutions, you have to go up the chain of command, and that chain of command will include people in risk and compliance who don't necessarily understand the technology. And the first thing they think of when they think of a blockchain is Bitcoin and crypto and nefarious activity. So, I think, JP Morgan has been at the forefront here, for organization that large to be leading the charge says something about the leadership in that organization.
100%. And we've seen some institutions, had conversations with people that have like full departments, such as JPM. And then we have other ones that have maybe one or two people allocated towards exploring digital assets, but maybe aren't ready to, put their full foot in the water, if you will. So lots of even diversity there in terms of, who you can work with or who can move a little faster than others. I do want to go into the forward-thinking questions, though. We did talk about some challenges. We do know that there's still a long road ahead to get all capital markets on-chain, or at least as much as we can. But what does a future with a tokenized portfolio of tokenized assets look like? Essentially a security token of security tokens.
Yeah, I think in the proof of concept for Project Guardian, we showed one example. We showed like a separately managed account example, right? So having these model discretionary portfolios, and you're able to kind of align to one of those model portfolios as your own personal financial goals and my own risk appetite. So that's one way that you can do that. And I think Meredith talked about this earlier, but what we really like about that use case is that personalization, customization aspect to it. Everyone has different preferences, not only in risk appetite, but also some people may want an ESG-focused fund. Some people may want a tech-focused fund. So that's something we look to explore within the Project Guardian POC. We actually had some customization built into it. So some of them had ESG-focused, passive fund. And so those are ways I think we can really leverage like tokenization to help with that, to your point, customization.
I like it. Yeah, you can get very granular with it, and so you can get it's fantastic. And by the way, there is a large transfer of wealth happening right now. So the new people that are receiving some cash, they have different risk appetites, different wants into what they want to invest into, and I'm sure their financial advisors are scrambling to figure out how do we make this happen and keep our client happy. So I think you guys are making this possible. But to that end, how will strategies change for evaluating and selecting alternative assets? Now that you would say that now that they're tokenized, they might trade a little bit more like a stock at least. So are there certain things that previously weren't really accounted for that now are? For example, analyst reports, earnings calls, or whatever. How do you guys see that changing?
Well, you're still going to need analyst reports and earning calls if it's a security. So there's, particularly on a national exchange or a national exchange that runs on blockchain or an ATS, SEC rules are SEC rules, so that's not going to change. But you will have different asset classes that we've never seen before. So life insurance as an asset class is something you can't invest in today. But if coal winds up chopping it up into $100 tranches, and now you can get a very nice risk-adjusted return, extraordinarily safe, and it yields 5%, great, let's do that all day. It has a place in a portfolio, particularly if you're now, again, not the 60/40 portfolio, but the Yale University endowment, where I want timber and I want wine and art and diamonds. Who's your CIO, by the way? Diamonds and wine? My wife? Is she? Anyway, just it's a weird combination. It's great, awesome. But yeah, we will need new constructs of how to manage these things.
I think the other thing to think about too is I think there will be a change, right? I think that we are able to do a lot more because of tokenization, but just from the other side of it, there's a lot of things that tokenization doesn't necessarily fix immediately, right? Like we keep on talking about it, tokenization is amazing, this is our job, but it's not, God's work, and it doesn't do everything that we need it to do. So for instance, it doesn't necessarily provide more liquidity. There's still a lot of work there to create the secondary market. It doesn't solve the KYC subscription process, anything like that. Tokenization doesn't really help the qualified purchaser, accredited investor requirement. So in terms of distributing it out to more individuals, there's still that blocker, right? That's just there because of the law. So I think there's still a long way to go, and to think about it, I think we need to focus on that first step, right, of what can tokenization solve, and then also think about, okay, what does it not solve, and how do we bring it all together?
And what are the implications of that? I completely agree, and I think to bring these two themes together, it's really about there's the technology aspect of what we can do, and then there's the regulatory framework of what is allowed, and that there's still KYC requirements, there's still, you have to be a QP or an accredited investor, so that's not going to change. So it's marrying these two to say, how do we make it more efficient, how do we make it more effective, but at the same time still abiding by the rules of the road. So I do think that's the intersection of that is where we're moving towards.
And let's touch on regulation actually. So, and just regulatory in general. Project Guardian is part of the MAS right out in Singapore. But are there other jurisdictions that you're also seeing being more favorable than others or more Web3 friendly?
We're mostly US based, so
fair.
Yeah. Any other?
Yeah, we're US as well. You can do most of what we want to do in the US. I would love to see more clarity around the ICOs of the layer 1 platforms. I don't think we're going to see that anytime soon. We would, I like to say, we would gladly file Ks and Qs, but you can't pay your validators in securities. So there is no construct for layer 1 to register. The rules just simply don't fit either way. But if there were rules, it would be great.
Fantastic. All right, so let's go down the line. Share with us either a prediction or just a last-minute message that you want to make sure the audience captivates from Project Guardian or what you guys are working on individually. Maybe start with Bob over at
Sure. I guess my takeaway from the last 2 days here is, I joined Oasis Pro a little over 3 years ago and started attending conferences then. And it's great to see many of the attendees here who were at those conferences in the early days. and the progress that we've made, not only as individual firms and businesses, but as an industry. And as I mentioned earlier, the momentum coming out of the Project Guardian announcement is tremendous. And I'd like to thank our partners, not only here on the stage, but out in the audience, some who I've met over the last couple of days, for really being collaborative and creative and moving the ball forward here. So a lot of good things to come.
He's going down the road. I think I'm most excited, so I'll give everyone it's public, so nothing that is hidden. There's a couple of S1s filed for a company called Figure Certificate Corp., which is obviously Figure and the team. But what it is a yielding stablecoin filed under the 1940 Act, but a very arcane part of the 40 Act called a face amount certificate. If it's approved by the SEC, and fingers crossed, it does, for the first time ever, you're going to have a stablecoin that yields like a treasury. And it's an S1 security, so banks can transact in it because SEC registered securities trump crypto within big banks. So we're very excited about the potential of that coming. So if you play that out a little bit further, think of a PayPal app on your phone, but instead of it not yielding, it yields. And you could buy, theoretically at Starbucks with it. You could replace your checking account, your savings account, your treasury account, and only have one wallet that holds a 5% yielding stablecoin that can be used for really anything that you use cash for. What I like about it is it reinvents money, and it's more efficient. And again, not doing God's work, but you're putting a lot of money back in people's pockets. So things like that are enabled by blockchain, like you couldn't do this without blockchain. It's enabled by blockchain, extraordinarily exciting. $700 trillion in the next 10, 15 years on chain.
I completely agree, and that's a big problem that we're trying to solve too, and I think that's what's really exciting is just how you interact with your daily finances is going to be revolutionized. And what I'm really excited for is the day that we stop talking about the underlying technology, because it's just so easy to use and it's just a better operating experience, like using your wallet. I don't know about anyone else, but I use my Apple Wallet for pretty much everything. I don't take a card out anymore. So you can see how that could really easily work, where it's not that much of a shift in actual consumer behavior, but just the underlying is better than what we have today. So I'm excited about that.
I'm excited about, I think there's been a ton of innovation in this space in the last, handful of years, despite things, going not too great and things now running back up. I think there's still been a lot of really awesome use cases that's been shown. From our side, we are really also excited just to continue building up our own ecosystem. And so, as I mentioned, we're opening up our chain. And so what that means is being able to bring utility to these assets that are on our chain and hopefully bring in other participants and developers and third-party owned applications. So I think that is a really exciting opportunity for ODA.
Fantastic. Well, you have made huge headlines when this came out. We were very excited about it. I'm excited to see what's come next, both individually and as a group. So fantastic work. Thank you so much for coming and joining us, sharing your insights. Like I said, we're excited for the future. Can we get a round of applause for our Project Guardian?
super trendy chairs. Has that worked? Nice.
The guys all good? All right. Good morning, everybody. We got day 2, Tokenize This 2024. Thanks for everyone's attention. Everything was good. Yesterday was awesome. Looking forward to following it up today. TokenizeThis Fireside Chat was great. Project Guardian was awesome. We're going to supplement that a bit more right now. We got the Digital Asset Infrastructure panel. I'm Peter Gaffney, Head of Research at Security Token Advisors, which is actually our own consulting and advisory arm. And here I'm joined by Jason Emery of DTCC Digital Assets, Patrick Martinez of Northern Trust. We got Lorenzo Ragati of Block Invest, and we have Mike Reed of Franklin Templeton on the end. Guys, if you just want to go down, Jason, and start, give a little intro about yourself, we'll dive into the firms a bit more.
Yeah, my name is Jason, and I joined DTCC just back in December as part of the acquisition of Securency. Prior to joining DTCC, I was the Chief Product Officer at Securency for a couple of years, and before that I was spent most of my career in the technology industry, specifically in telecom. I should talk to Carlos. So have had experience in product management, engineering, development, marketing, and that sort of thing, and today I run the product team at DTCC Digital Assets.
Nice to meet everyone. I love the chairs. Super comfortable, so thank you for that.
We're never leaving.
Yeah. Patrick Martinez. I sit on the Digital Asset and Financial Markets Group for Northern Trust, based here in Chicago, and lead the strategy and innovation work for the bank in region. If you're not familiar with NT, it's a large global custodian. So we're responsible for roughly 16 trillion in client assets. We sit in over roughly 100 markets globally. And the team's mandate is pretty simple. It's to, one, disintermediate ourselves from within, and then two, look for new opportunities to drive revenue and growth. And the backdrop of that is obviously leveraging blockchain technology to kind of bring new products to market, provide safe market access, and safekeeping among a number of other asset services. So nice to be here today. Thanks for the invite and looking forward to the conversation.
Lorenzo Rigatti from Italy, Milan. I mean, long trip, but it's worth it. Yeah, the funny thing is that I used to work as an engineer, okay, in cruise construction. But thanks to a guy from Miami, I discovered Bitcoin. I was kind of obliged to buy Bitcoin back in 2015. So, I mean, I was lucky enough to being able to quit my job and start working on the crypto space, before in Switzerland in Crypto Valley, where everything started. And then I founded Block Invest 4.5 years ago. And we are, I mean, the leading tokenization provider in Italy. And here we are.
And I'm Mike Reed. I work at Franklin Templeton Investments in the digital asset unit. We've been engaged in blockchain builders, investors for years now, since about 2017 or 2018. Can't remember exactly. And I'll get into some of the initiatives we've been working on. I lead partnership development, where basically we go out and try and find people who are doing interesting things and see if we can do interesting things together. Sometimes it takes the form of us investing in them, sometimes them investing in us, sometimes technological partnerships. It really runs the gamut. And I would like to second the chair comment. There was a lot of pre-game anxiety about getting in and out of these chairs. I'm a heavy-set person, and I'm really thrilled to be able to sit in it and feel comfortable. So thank you, Peter.
I love it. That's the key right there. Awesome, guys. Thanks so much for the intros here. Listen, this is about infrastructure. And usually when I think infrastructure, I'm thinking like, okay, an issuance platform, a blockchain itself, could be a marketplace. But also in this space, given kind of the precedent that has to be set, you could even look at different proof of concepts and products as infrastructure themselves. Like ETF wrapper is a great piece of infrastructure, in my opinion, for new assets. So Mike, I actually want to throw it back down your way, looking at the Franklin U.S. On-Chain Government Money Fund. I know that was incepted back in, I think, April 2021 officially, obviously a hot topic the past year and a half. That is infrastructure to me as kind of a precedent-setting product. If there's anything you want to share about that and kind of how it came to be.
Yeah, thank you. We're really proud of it. Someone yesterday said, nobody has put a public security on chain for US investors yet. And I kind of took issue with it because we have. We've done that. We took a fund called the Franklin On-Chain US Government Money Fund, which is a SEC-registered 2A7 government money fund, very traditional fund wrapper. And the way that, excuse me, the way that you buy that product is either through our app, which you can download at the Apple App Store or Google Play, or through an institutional interface. And investors can buy a token we call Benji. And one Benji token is equivalent to 1 share of the Franklin On-Chain US Government Money Fund. And that fund pays interest daily. It comes to you in the form of an airdrop of new tokens into your wallet every night, overnight. We built the wallet infrastructure ourselves. We built the on-chain transfer agent ourselves. And then maybe the thing that I'm really excited about, which I say often, is that our minimum, it's not for qualified investors, our minimum is $20. So it's very accessible to everyday investors. It's a real nice entryway for them to be able to gain access to on-chain assets. It's a way to legally earn yield on-chain. So we're thrilled about it. And our whole, did you want me to talk about like why and how and all that kind of stuff? Okay. So the kind of why and how, embarrassingly, this whole project came to us really more as a thought exercise where we were learning a lot about blockchain technology and how it worked, and we thought about trying to find efficiencies within our own business. And so when we started deving the project, yields were at 0. There was really no interest in money funds at all. We did it really, like I said, as a thought exercise. And so we started building. We built initially on Stellar as our blockchain. We're now live on Polygon as well, and have filed to dev on more chains. But we learned a lot of things out of that initial build that really helped to propel our digital asset business going forward. So what started as a thought exercise really blossomed into a whole array of opportunities. For example, we learned, and this is probably evident to everybody in the room, but at the time it wasn't necessarily evident to us as we began learning and began our journey in the space, all the chains are different. They offer different communities, they offer different cost structures, they're all very unique. And so picking chains on which you develop is really important, and that came apparent to us before we had even chosen what chain to develop on as we examined all the landscape out there. Another thing that was really interesting to us was the cost structure piece of it, where we could really crush our transfer agent costs and remove, almost, make that function relatively cost effective for our clients and be able to pass that benefit through to our end clients. So the Benji product actually pays more and charges less than the other money funds offered by the Franklin complex. So we're really excited about that. Then we started to learn that not only are all the chains different, but there's all these tokens out there, and they're all different. They all represent different projects and protocols, and some of them have, only governance, a governance quality to them. Some of them have real tokenomics to them, real economic feedback to the token holders. Again, this is all evident to everyone in the room, but as you're in your early stages of your journey, remember with me, you start to look at this stuff and you're like, wow, this is all pretty amazing and expansive. And so out of that, when we start to hear about different economic structures, different, how things have different values, we started to wonder about putting price targets on them. And so we began to build an investment strategies unit. We offer a few of our investment strategies publicly in SMA form through Eaglebrook Advisors, where we offer multi-coin portfolios to retail investors. We also have a VC unit as part of our investment strategies unit. So that became this whole learnings that came out of all, just what started as this thought exercise. We started to figure out, oh, chains matter, tokens matter, portfolios of tokens matter, offering active advice on those matters, all that kind of stuff. And then the last thing I'll mention, sorry, I know I've been talking for a while now. The last thing I'll mention is we also operate validator nodes on multiple chains as well. And to us, we really have this belief that you have to be part of the network to understand the network. So we were one of the groups that you mentioned the ETF structure. So we were one of the groups approved to be able to launch an ETF structure earlier this year. We launched a product called EasyBC, which is our Bitcoin ETF. It's not a cash grab for us. It's not a land grab. We're really thinking about this as a holistic way to approach this, this total space. So we have a real comprehensive way of thinking about it across the board.
I love it. Great breakdown. And not to give you a rest just yet, but I believe Benji announced peer-to-peer transfers recently as well.
Oh yeah,
right,
yeah,
on
yeah.
that side?
Yeah, thank
you.
you.
What's the final vision there? Like,
Thank
is
you.
it, it's all within the app itself. We were talking about ecosystem interaction in a previous panel. Anything?
It's like being on a podcast and someone saying, "Don't you have a movie to promote?" Thank you for that. So yeah, we announced peer-to-peer transfer ability in Benji, and it's so funny. I think last week we announced that, right, Rick? Last week? Okay, thank you. My colleague Rick Golubov in the audience. And so we're super excited about that because, you know, about a week prior, I read this article about somebody talking about how account-to-account transfer was the future, and we're still such a long ways out for it, and nobody's going to be able to do it for years and years and years. We've done it. We've done it. Now, as a Benji holder, you can transfer your Benji tokens to someone else, and I'll give you a very specific use case for that. So you know, you could pay your vendors in Benji. You could hold Benji as part of your treasury and allocate it however you want. We just think about all the use cases. And one interesting use case was a VC client of ours talked to us about how he was really excited to fund his portfolio companies in Benji tokens. And he said, he's like, usually what I do is I sell out of a money fund, I transfer the cash over, and then I hope that the portfolio company invests the cash in a money fund. He said they don't always do that, but that's kind of what I'm hoping for. And that whole time, that whole process takes 3 to 5 business days. The cash is doing nothing. It's earning yield for nobody. Well, the bank, but it's not earning yield for the portfolio company or for the VC themselves. So he's really excited to be able to instantly transfer a yield-bearing asset. He's giving a portfolio company something he wants them to hold in their treasury. And not only that, but then it's sitting in a wallet, and you can see how the spend down works. You can see how the burn rate works of the token in the wallet. So it's this really interesting thing that we've been able to unlock for our investors, and we're super excited about it. Thanks for bringing that up, Peter.
And of course, and Mike, out of curiosity, what is this all through the Benji Investments app? So look, if a landlord was onboarded, theoretically he could have tenants pay him in Benji all through that app? That's
the idea, yeah. So you know, you could think of it as an alternative payment effort. We go out for dinner. I want to pay for my half. I can pay you in Benji tokens. So we're unlocking, you know, new feature sets, new capabilities for our product all the time, and we're super excited about the future.
Beautiful, awesome stuff there on the infrastructure side. Patrick, I want to look at Northern Trust next. You know, you guys are a tremendous custodian. You have an asset management arm. You're already connected with like bond blocks over in Singapore, I know, on the fractional bond side of the. Oh, so that was a very cool case. How should we think of you? How should the audience look at Northern Trust right now to kind of work with you on the digital asset side?
Thanks for that. And Mike, that was really well said. I'm rarely am I speechless, but you told a very succinct digital asset story, I think, for large institutions. And so I echo most of, if not everything you've said. And I think from a Northern Trust perspective, again, as a global custodian, we have one primary responsibility downstream from everything that Mike's discussing, and that's safety and security. And so when the buy side or an end investor wants to purchase, it doesn't matter if it's traditional or digital asset, they rely on their custodian to ensure that nothing happens with that asset. It can't be stolen, it can't get lost, there's an active record of it, and that they can transact in the capital markets in an efficient manner. And so from an infrastructure perspective, we very much think of ourselves as almost a middle layer to how investors access the capital markets. And so that can take a lot of different forms. I mentioned in my intro that we sit in over 100 markets globally. Well, we have a massive, what we call our network management arm, which sits in region in one form or fashion to ensure that if a client is investing in the US or they're investing in Nigeria or in APAC, that they can do so in a safe and efficient manner. And so that requires a lot of due diligence with the local depositories in region, the central banks. We try to understand rules and regulations, kind of package all that up and give our clients the comfort that they can invest in that region. And so the digital asset lens to that is very, I think, complementary. We look at these new and emerging ecosystems as just that, almost new marketplaces, new jurisdictions for us. And so we are taking that historical lens that we've always applied to financial markets and applying that now to blockchain and enabling that safe and secure access. And so from a product perspective, the group's been around since 2017, and the very first thing we launched was a tokenized private equity platform. And so what we did is we converted GP and LP agreements into smart contracts that manage the entire life cycle of a private equity fund. We ultimately sold or licensed that product to Broadridge in 2017. So since then, we've been engaged in Singapore in bond blocks, which is tokenized fixed income assets. Northern Trust provides the custody of the underlying bond, and then that is in partnership with Citi. And in that exchange, we announced late last year the Northern Trust MVP carbon offset platform. So taking carbon offsets, tokenizing them, putting them onto a DLT blockchain, and we're allowing institutional buyers and high-quality project developers to transact in tokenized carbon offsets. Obviously, as a custodian, you can imagine that we are heavily involved in the digital asset custody side of this, and we're really excited about a lot of the work we're doing, especially in the United States, around custody for digital securities. We've been on that journey for a bit now. The transfer agency piece is obviously a big part of the conversation. But then obviously opening up the secondaries, I think, is kind of the next step for us. It's one thing to put something on chain. It's one thing to natively issue a security. But clients immediately start asking us, what do I do with it? Why is this beneficial to me? And the money market conversation, I think, is really fascinating. There's so many use cases for it. What happens if interest rates, knock on wood, go down? Does that make the money market fund conversation more or less appealing relative to cash? And so we're really just trying to make sure that, again, we cover the entire ecosystem. We look at this sort of integrated approach to financial markets, all with that ethos of making sure our clients can access those markets in a safe and secure way.
I did not know about the GPLP tokenization back in the day. I was just talking about that yesterday. Here, we'll have to pick that up later. You mentioned the integration side, like the custodian. They're managing, they're holding the cash. They have the money there. I think what's a big limiting factor right now in the tokenization space is that the custodians that are playing ball with a lot of the service providers we've been seeing the last couple of days, all also startup custodians, all building their book of business. Like you guys, other tremendously large custodians on the legacy side kind of hold those keys to really unlock meaningful capital. Is there anything you could talk about on the integration side, whether you're working with other startup tokenization platforms, doing things in-house? I know, some things you want to kind of keep to yourself, but like anything on the integration side we should think about, because that's really where I think a lot of our audience interest is going to lie.
It's a fantastic question. I don't know if I have a great answer for it. I'll throw out maybe just a couple of anecdotes. So, number one, being a large financial institution is both a blessing and a curse. So on one hand, you're correct, we have significant distribution. If you are a large asset owner or a large asset manager globally, there's basically a 1 in 3 chance you're already an NT client. Our thesis is that between 5 and 10% of our client assets will be digitalized by 2030. And so at a place like Northern, if you apply those numbers, you're talking about somewhere between $800 billion and $1.6 trillion in assets here in the next couple of years, so it's significant. And that's just at Northern. You start applying that to State Boney, JP, et cetera, the numbers get pretty large. And so on one hand, there is built-in distribution, which is really important. And so there's that integration component to it. The downside of it is you're dealing with a large, prudentially regulated financial institution. And so we will not ever take undue risk. And we obviously have to comply with the rules and regulations of every jurisdiction that we are in. And so whether it's the US or the Fed here in the US or the FCA across the pond or wherever, we have to comply with those regulations. And they look at that globally for us. And so when you start thinking about then, okay, well, if I'm a newer company and I'm trying to get access to that distribution, the things that matter to me are actually some of the boring parts. So number one, to get on board at a place like Northern, you have to go through this wonderful thing called procurement. Well, if you've never gone through procurement for a large bank, buckle up, I owe you a drink, because it's cumbersome and takes months, if not years, quite literally. And that's because our third-party vendor management programs that every single large financial institution has is very robust, complies with federal guidelines and regulations. And if you can't meet those benchmarks, you're never going to get onboarded at a place like Northern. It doesn't matter how much we love you or your product. Your risk profiles, the way you view resiliency and cybersecurity risk, those are the types of questions that, when we start looking like how do we integrate the innovation side to it, become really important. So I think it's some of the more mundane things are the ways to get access to the large distribution that all of our firms have.
Very, very familiar on the procurement side. Thanks, Patrick. And you mentioned different jurisdictions. Obviously, we know that's a key, catalyst right now on where a lot of players are going in general. On the banking side, Lorenzo, you guys are, to my knowledge, the most prominent platform in Italy specifically. You're working with the Bank of Italy in the Milan hub, I believe it is. You're working with Credit Agricole pretty closely. I know you've had other deals on the fixed income side, I believe, over the past couple of years. What are you doing with the Bank of Italy specifically, and kind of how are those inroads being built with Block Invest?
Yeah, I mean, in the last 2 days, we underline how important it is to talk with the regulator and work with the regulator. Because, we need to be honest. Create a token, it's easy, okay? But to enable something like Mike was describing, the huge part is work on the processes, right? So we started our venture with a precise goal to tokenize the process, not just the product. And with this approach, we follow what was an opportunity for us in Italy. I think many European countries are doing the same. And we got selected twice by Bank of Italy for 2 different projects. One in capital market, particularly for what we called mini bonds, so bonds issued by SMEs. And the other one for a very particular underline that I think no one touched it in the tokenization, which is the distress credit. So we provide also solution for the tokenization of distress credit, particularly with the real estate collateral. And with the Bank of Italy, we, let's say, co-design, okay, our tokenization platform should work, but for real in production. Particularly for the primary issuance, for also, let's say, design a model for the secondary market without obliging our client to become an MTF. So, let's say, the only way, as far as we think, to make it happen is let institutional use the blockchain for real. We don't need to give it for granted because it's not. Okay, we've seen a lot of projects that are, let's say, more marketing that real project. But the only way to do that is also provide detailed information to the regulator on what's going on chain. But for what's going on chain, that the asset manager should have his own account and deploy the token. Okay, the custodian needs to have its own account to check all the compliance issues. The fund accounting needs to update the net asset value on a daily basis if you're talking about an open-ended fund, and so on. And also the regulator in our platform has its own account to check what's going on. Because we need to prove them that this technology is not just to make something different, but to help the regulator do his job, even in the easiest and a better way. So, and it was a great thing for us. It was a long story short, apart from Bank of Italy, also our financial regulator, so the CONSOB, so your SEC, issued a regulation last year, and today we are the only infrastructure provider enabled in Italy. So we are quite proud of that. But the only way to make it possible again is co-design the processes. It's not only tech. Tech is fundamental part, but the business side and the compliance side should be, primarily highlighted in the tokenization process flows.
Is the Milan hub, is this a sandbox mode, or is this something that's live right now?
It was a sandbox last year, and now it's live. So we have seen a lot of things going on in the last 6 months after this regulation. So just to give you a number, like 80% of our revenue last year were made in December, because all the industry were waiting for this regulation. And now we have launched also for Italian market our new solution, because we started, even if we are Italian, we started in Luxembourg on other use cases, particularly in green bonds and in UK for the tokenization of equity of SPVs for, real estate, particularly commercial real estate. Now we're working with big players, so banks, asset manager, and also another very institutional project that, you will see presented, finger crossed, directly to the ECB next month. So now, let's say it's live and we just started. As we used to say, one block at a time.
Beautiful. And looking at infrastructure, distribution is key. Is there anything you're doing specifically on with different fund admins or kind of distribution groups on even the placement agent side? Are they also getting plugged into your process, or is that something that's still kind of in the works, would you say?
The only account that doesn't make blockchain transaction is Block Invest account. So our model, so we are B2B, or as our marketing used to say, we are B2 bank. So are the institution that use the platform, that plug the platform, and directly use the distributed ledger, let's say in an easy way, is not that easy. So it takes time to onboard the clients, but the great thing is they use the new technology, so the distributor makes his own work. They just use the blockchain to make transaction faster and, let's say, safer. But yeah, this is our model. We are not the distributor. We're just your tech guy that can help you to bring your processes again on chain.
So again, integrations are kind of the name of the game, right? Get them through the workflows, get them in the on-chain process with you guys, with other groups. I get it. Makes total sense. Speaking of that, Jason, so from Securrency to DTCC, digital assets, I know at Securrency you had I always thought it was very cool, the compliance-aware token framework. When I joined the industry a few years ago, it was bright-eyed, bushy-tailed, like, oh, okay, cool, you could go to any jurisdiction, rely on this framework to tell you what's right, what's not, get blocked out if you can't get to somewhere. I know it goes way deeper than that, but I think that has a lot of legs. Whether that's right now, in the future, that's something to always keep an eye on. But do you want to just kind of share some of the other segments that DTCC Digital Assets is supporting right now, whether that's the Composer, Ledger Scan, Analytics, the compliance-aware token framework, anything like that?
Yeah, thanks for the opportunity. Appreciate the chance to be here and talk with you folks. So what I want to do actually is talk a little bit about the barriers. We talked a lot over the course of the last couple of days about the opportunities and how things are growing and that sort of thing. What we're thinking about at DTCC DA is what are the barriers to keep us from adopting this technology more broadly and at larger scale? And really there are three primary things. The first thing is data standardization. So when you talked about all the different tokens that are out there, all the different blockchains and all the different technologies that are out there, we need to really figure out how to standardize information across that technology and across those different token standards so that when somebody wants to know what are the money market funds that are available out there in the ethos, they can find them. There's a way to find them. And you need to be able to aggregate that data across blockchain technologies. When you said that the technologies are all different, the way tokens represent information is different. And so being able to collect all that information and normalize all that information, then enrich it with pricing information or with PII from off-chain sources, that's all things that need to happen in order for us to really understand what's going on in the ecosystem. So data is really key. The second thing is around liquidity. And I use that term really to mean the ability for us to use these tokens to do something. What ends up happening in a lot of the proof of concepts especially, but certainly even in some of the production releases, is you get these tokens and you buy them and now you've got this little pet rock. You really can't do anything with it. And so being able to take that token and use it to pay for dinner or to use it maybe more importantly in something like collateral use cases or as a repo use case, that sort of thing is what's really going to unlock the desire for people to have tokenized assets. It's kind of the supply and demand. You know how to create the demand for these tokens by building applications and use cases that actually demand tokenized assets. That's kind of the second issue. And the third thing is around infrastructure. We talked a little bit a minute ago about JP Morgan Onyx. Yesterday we talked about Coinbase and their ecosystem. We talked about the Benji ecosystem. I think one of the things you heard common throughout all those is the requirement to build your own infrastructure. You had to build your own TA. Securitize built their own TA. So I think what really needs to happen in the industry is we need to figure out what is that common infrastructure that we all need in order to really make this capability take off and grow. And so you talked about the compliance-aware token framework. What that's really about is the ability to embed policy rules that govern the movement of value no matter where it goes and from where it goes. And that's a framework that crosses blockchains, crosses token standards, and gives you the ability to manage that across the entire ecosystem. And so that kind of infrastructure layer that is necessary is going to be something that we need to think about how to create those common components.
Are you seeing, let's say, demand or usage of the compliance-aware token framework from,
Yeah,
from
so
your end?
it's really just starting to grow. We talked yesterday, I think, a little bit about interoperability. And so the ability to move a token from one chain to another and then leverage it in an application is an example of a use case that we did with Avalanche and with the Wisdom Tree folks and with Wellington last year that showed how you could take those compliance capabilities, start in one chain, and actually see those compliance capabilities represented on the next chain, and then leverage that token in a collateral management use case where we were actually completely automated the securities lending solution from soup to nuts. Every aspect of it was automated in a smart contract, and the collateral, the token that was created and moved across chains was used as collateral in that securities lending solution. So we're starting to see the use cases come to life and really see how that's going to be beneficial to the ecosystem.
Nice. Yeah, that was a great case to see come through. Something we've been talking about for a while: collateralization of tokenized assets.
Yeah.
Can I steal your thunder
Please,
for your
go
role? Because I actually have a question, because I think this is really fascinating. And we saw this, I think you mentioned obviously JPM. I think most people saw this, but the very first US muni bond that was last week. And what's notable in the offering statements or the issuing documents is the absence of DTCC. And Northern Trust has a lot of strong relationships with a lot of the investment banks, and where there is not an explicit depository requirement, we're seeing some of the large issuers issue these securities or register them on their own TAs or in other models. And so my question is, as you're talking about the DTCC, just even personally for me, how are you thinking about that model? Does DTCC's role shift from this books and records and registered ownership role that it traditionally has and into this more platform role? I mean,
that's a great question. Some people even go so far as to say blockchain could disintermediate DTCC, and I think the reality, in one sense, DTCC is kind of the consensus layer of traditional finance. It's where transactions are settled, cleared and settled, and so you could jump to that conclusion. But I think that the reality is that DTCC's role is more of a governance layer and more of a management of the relationships with regulators and the definition of how things are supposed to be handled in case of stress and that sort of thing. And so I think when you ask the question about what's DTCC's role going to be, so one thing we're looking at is in each one of those ecosystems, these use cases come to life. You've got the Benji token. How does the Benji token interact with the Coinbase ecosystem? And once you cross those boundaries, there's got to be something that stands outside of the blockchain technology to manage the interaction between the blockchain technologies. And that sort of role is where we think DTCC can continue to play. I also wanted to just highlight one aspect there. Earlier this morning, I heard one of the commentators mention industry sandbox. I think one of the things that we need to do as an industry is come together, as opposed to having these kind of siloed use cases and proof of concept activities that expend a lot of money and they prove out some technology, but it's really in isolation. Coming together as an ecosystem, coming together as a complete industry, and to focus on the key pain points in the industry in an industry scale sandbox is, I think, something that's time is due in the US.
Very interesting. What type of stuff would you want to see in the sandbox? Like, what if you had to pick the most pressing thing to start working on with, let's say, other panelists on stage, like other collaborators in general? What would that topic be?
Well, I personally think that repo and collateral management is going to be what unlocks tokenization, generally speaking. And I'd like to see how that kind of a solution can be offered across the industry in a way that's really crosses blockchain technologies, crosses token standards, and crosses implementations.
Yeah, and I think rolling that out more generally to other asset classes would also be pretty cool. And we've been talking about that for a while, but really if you can build it out on the repo side with super high quality liquid assets, eventually move to a bit more, move up the risk curve we were talking about yesterday a little. It's fresh in my mind. But to start working other assets in similar just lending capabilities would be tremendous. And in general, like what are some of the catalysts? So Jason, we were talking about barriers to entry, and this is going to be open just for the floor. What are some catalysts that you guys think are impending? Not that you'd want to see just on a broad scale, but what do you think is really in the near term that might help unlock some of what you guys are working on?
I mean, it's easy, at least for us in Europe, a stablecoin. We don't have a stablecoin like you do in US. The funny thing is that the biggest stablecoin in the world is funded and managed by Italians, but we don't have a stablecoin in Europe, or some sort of central bank digital currency that can be represented on chain. I mean, just speaking about numbers, we are working on a huge project on an open-ended fund tokenization, and we have reduced the timing of subscription from T+4 to T+2, T+1 in the night. But I mean, let's say with a fund accounting that is equipped to give the net asset value the soonest, and a cash on chain, you can even reduce this timing. And we were talking about the settlement time on the I mean, great Benji project, but I know that we just started, but think about it, that one of the parameters of the GDP is the velocity of the money. If you're able to increase the velocity of the money, potentially we can increase the GDP. Okay, so I mean, this is, I think, the most important stuff. And
well, that's good. I mean, yesterday we were talking with Galaxy about their euro-denominated stablecoins. There could be some legs and some motion on that front for you guys. Mike, anything that you would want to see in the impending, or just in the near term?
This is more like a philosophical comment than like a specific utility, but I don't know how to say this nicely, but I think people need to be more authentic in the way that they approach the space and more genuine in it. I think, I mean, you can tell from the blockchains I mentioned earlier how we feel about the public versus private debate. Well, whatever, you can tell from that. I think, like Benji, for example, is not a mirrored asset. It is authentically on-chain. You authentically own that asset on-chain. We don't run parallel books off-chain and mirror them on-chain. Like it's authentic. And I think there's a lot of like large products that compete with ours that are not. And I think currently maybe that's not such a big deal because people are just excited that there's other players in the space. But I think as time goes on, I think that authenticity is going to matter. It's going to be of the utmost importance. I think about, like we get asked a lot about, because we're in kind of an innovative group at our firm, so we get asked about AI like all the time. And I think that the intersection of blockchain and AI is really going to come in that authenticity layer, where the authenticity is coded at origination. It's hard-coded into the asset at origination. You think about like deepfake technology and all that kind of stuff, where authenticity is coded in at origination. So I think doing things authentically on-chain are going to matter. We've noticed, can I plug something else? We have a Twitter account, FTI_DA. It's our digital asset Twitter account. It's not run by an outside department. It's not run by people who are putting fluff up there. It's actually run by us. We run it in the digital asset account, which some salespeople thought we were hacked at one point because we were posting some really interesting crypto-related stuff up there. But we post research on all of this regularly. We posted a piece yesterday, I think it was yesterday, on Base. We posted something last week on Solana. We've posted things in the past on, our very first post, which was a few months ago, was on the halving before that became kind of the topic du jour. And so we're authentically in it. And what we found is that our competitors are very quickly becoming our collaborators. And the ones that are more authentic in the space are the ones that are kind of more aligned with, I think, the ethos of blockchain.
Yeah, 100% agree. I think when we think about bringing all of this value, I think, the numbers range from, something like 10 trillion to $16 trillion worth of value on chain by 2030, depending on who you listen to. I think we have to start focusing on the things that are really going to matter. Things like quantum attacks. What happens if somebody develops a quantum computer that can actually decrypt a blockchain? Right? How do you handle those sorts of scenarios? And so I think we need to really, as an industry, focus on the things that matter.
And I'll add, so I want to piggyback off of the regulatory and compliance issue, and I think as the US goes, so does the rest of the world in terms of adoption. Things like SAB 121, which the House of Representatives recently passed a proposed bill to pull that back. Support that, I would recommend that. But those sorts of things are huge catalysts for the large financial institutions to really get into this space. So regulation's one. The other one that, beyond sort of the product and technology innovations, I think is kind of twofold. Number one is the demand side, and we actually have to start delivering real tangible value to A, our firms, but B, more importantly, our clients. Our clients don't really care about the technology. When I sit in front of a large pension fund or one of the largest asset managers, the Franklins of the world, they don't really care if it's blockchain or not. They care about, what does it do for me? Do I generate additional yield? Does it provide expense savings? What are the unit economics? And we've not, as an industry yet, nailed this. And so we really, my tagline for this is, we've been in the business of innovation, but we really need to fight to turn this innovation into a business. And that's important to our executives. At the end of the day, we're all publicly traded companies. The bottom line really matters, and so we have to move beyond this POC, the hype, the, hey, we're just building things, but we need to really create commercial value for our firms and for the investors, and I think figuring that out will be a huge catalyst.
I think it's hard because a lot of the stuff we're talking about is ops, and it's like not the most exciting thing in the world to talk about or think about or anything like that. We got lucky. Our CEO used to run ops for the firm, so as soon as we started talking about blockchain years ago, she got it immediately, but it's really hard. And I just, piggybacking off your comment on regulators, your comment on regulators as well, we found the regulators to actually be, interested, engaged. They want to learn more. They see the benefit right away. So there's this weird thing in our space where there's a whole cohort of people who really want to act as, I don't know, like anarchists, or they're
activists.
Yeah. Which is one tactic. Another one, which we've been able to kind of thread the needle on, is partnering with the regulators in terms of being like education, like this. It's this collaborative effort, and it really feels like that's been a kind of the key to our success so far, has been engaging actively with the regulators instead of just trying to build something and hope that they say it's okay. We work with them together.
But let me add something, because Mike said the word private blockchain, something that I don't know what it is, apart from joking. I couldn't agree more. So remarketing a database, okay, let's use the database, probably is cheaper and even safer. The fact that most of the use case till now were just digital twin, I mean, we call it gadget. So you're in the marketing budget of the company, okay? If you issue a native token on chain, means that the token exists only on the blockchain. I mean, first of all, talking again about compliance, you oblige yourself to, in the prospectus, declare that the token exists just in the public ledger, and you oblige yourself to follow the whole process on chain. And this, I mean, I think can bring another value in the long term. The thing is, most of the time, I mean, the improvement also at the process level are not tangible with just one fund tokenized, okay? It could be, they're great, but I mean, the great value will be when everyone will tokenize his asset, and we will be able to bring the value on chain together and without the need to create the Chinese wall. Because this is the risk. I totally agree with that. So we need to use the blockchain as a common layer, as a settlement layer, because it was born with that. I mean, Bitcoin was created exactly for that. I mean, to exchange value and trust. And this is what we need to do. It's a long path. We need to work with different regulators all over the world, because my regulator works differently from yours. But the only things that we have in common is the layer, is the blockchain. So the only way is to use the pure public blockchain. And yeah, we will make it.
You guys are on the money. Front ran my question about digitally native versus digital twins, so I like it. We're all thinking the same way as we're going. Listen, we're coming up on time, but I want to give a chance for kind of parting thoughts, if you will. Just any final takeaways for the crowd, Jason, if you want to.
Yeah, just to reiterate my comments about collateral, I think that's the reason why I think I'm so interested in those types of use cases that really drive a specific value. You can actually you can do math and figure out what the value is going to be of getting an extra hour out of your access to cash. And so I think those types of use cases are the ones we really need to drive.
I think that the point about end user benefit is really well taken. There has to be a benefit to everyone. It can't just be, you're running something and you save a bunch of money and then you keep it all to yourself. Again, away from the ethos of blockchain, there really has to be a benefit to the end consumer for a lot of this stuff to be adopted. And again, we're super excited for the future around all of that.
I mean, this is a great moment, I think. I'm optimistic for what I'm seeing, even if, again, we have this constraint of the cash lag. What we see, working with several financial institutions, is that apparently competitors want to work together. So what is missing and can be created a real capital market union, but not, with let's say, listed product. The title today was Wall Street on Chain. Probably, listed things can be there. But if you work on assets that work to tokenize, and we work together, and we build an ecosystem of standards, I think that, the benefit would be for everyone, particularly for the private retail investor that till now were excluded from this kind of asset classes.
And then just quickly, from my view, I think it's, and maybe you could say this every year, but I think it's the most critical point that, at least in the 5 years I've been in the space, it's the most critical moment for digital asset and blockchain adoption that I have seen. We survived, obviously, the crypto winter, but I think at some point we run out of, no pun intended, chain or leash, if you will, to continue this work. And so I think it becomes really important right now to prove why this is valuable for the marketplace. I see a lot of teams starting to dissolve, groups shifting resources. I think executives sort of now really questioning, hey, this was fun and cool, but we're on the AI thing now, and where is blockchain in this? And so I just think it's really, really important for us to kind of put up or shut up, if you will. I tell my kids all the time, don't talk about it, be about it. I really feel like we're in that moment, and we have to seize that.
Love it. Well, amazing remarks, guys. Really appreciate the time, gentlemen. Everyone, this was Digital Asset Infrastructure. Let's hear it for the panelists. Audience was all great. We got another session coming up right after this.
Thanks.
There we go. All righty, before we break for lunch, we have one more special announcement. So, without further ado, we have Denari Gabriel Ott.
Thank you for the one person that clapped. Good afternoon, everyone. My name is Gabriel Ott. I'm co-founder of Denari. A friend of mine yesterday looked around the conference and said this was the most boomer crypto conference that she's ever been to. And so I apologize in advance if I use terminology that don't make sense. And as someone who previously employed many of my own generation as well as Gen Z, I apologize for my generation in advance before we start the presentation. So, Denari is a global RWA distribution network. What does that mean? Well, our mission from the beginning, since 2021, has been quite simple. Connect users from around the world to the most important financial devices on-chain, real-world assets, which is the reason why we're all here. But when we looked at the space, there was kind of an interesting problem. Mainly, we had issuers that were interested in tokenizing RWAs, so they turn it into tokens. And then the idea would be that that token would be pretty easy to buy and sell for users on the other end. And so while many issuers have now begun tokenizing their offerings for management efficiencies and things along those lines, the tokenized RWAs haven't gotten any easier for consumers to gain access to around the world because distribution for tokenized assets is still pretty much in its infancy. So last year, Denari started testing out a way to distribute on-chain stock tokens that we call D-shares to users through stablecoin purchases, working with clearinghouses to make sure they're one-to-one backed. So these were things like Apple shares, Google shares, even ETFs that we sort of tokenized with our clearinghouse partners. And the idea was people can log in with their wallets, use stablecoins to essentially purchase these shares, especially in parts of the world where this was not particularly accessible. The problem, though, is we still hadn't solved the distribution problem very well because signing in and transacting with wallets still sucks a lot for anyone who's actually tried doing it. It's still a pretty difficult concept for users to grasp. So instead, we actually built an entire API layer on top of our sort of tokenization scheme, such that Web 2 apps all around the world could actually gain access to these shares and distribute it in a white label form wherever they were and to users that they already had. I don't know if some of you are aware, but if you're looking at numbers, there's about somewhere between 150,000 and 200,000 active crypto wallets that are trading in all of the EVM networks. And that number was staggering for me because it's such a small number when we think about the millions of wallets that actually exist. And so by creating this API layer and allowing for existing apps to essentially trade our assets, we actually unlocked access to millions of users. So what we did with the APIs made it easy for everything from local trading apps to wealth management software and even payroll platforms to enable purchasing of our D-shares on their platform. We're able to amass millions of customers actually through our API distribution partner. And you can see here, they're literally using their own branding. You don't see Denari anywhere. It's kind of a white label solution. They use their own marketing dollars essentially to spread our assets in these Web 2 apps. And so there's no signing with wallets, nothing along those lines. It really is anywhere there are already users, we are able to provide our on-chain tokenized RWA assets to them directly. And this distribution method was so successful that our API partners combined will bring over 10 million users who are already KYC through their own platforms to have access to Denari tokenized assets this year without having to ever touch a wallet or even knowing about the Denari network. So just to step back for a second, we've been building for the last 3 years, working on regulatory licensing, partnerships with clearinghouses, building compliant methods of bringing tokenized stocks on-chain in the most transparent and trusted way possible, all to bring about our founding vision of building a true global marketplace for RWAs. And so here's the announcement part. This fall, we're actually building upon and generalizing the lessons that we actually learned from our Denari Bridge and the DShares API. And we're launching a fully compliant, decentralized exchange portal made specifically for RWAs with the specific needs of RWA investors, issuers, and market makers in mind. What are some of these features? These features include passive geolocation and AML, ability to enforce localization of assets down to the contracts level, so not just at the UI level. So you can literally pick the countries where your assets are available. You have variable and progressive KYC, so it's not like an all or nothing proposition. Users will be able to KYC up to the level of the assets they want access to. The liquidity will be pooled across off-chain and on-chain assets. We're introducing through partnerships new financial devices where it's legally possible to launch them, such as perps and options. And of course, across all of our apps, we have these KYC users that are going to be shared across the network. And the whole idea with the API distribution network, meaning with a simple integration, you can put your assets in front of these users around the world on whatever apps they're using to buy and trade on-chain assets. And in order to access DeFi users directly, we're partnering up with the Plume L2 network. If you guys haven't heard of the Plume L2 network, you guys are going to be hearing about them a lot more very soon. They have amassed over 200 RWA issuers that are kind of waiting in the wing to gain access to the Plume platform, the Solid Violet platform, all of which is launching in the fall. And really, they've been doing a phenomenal job of accumulating on-chain user interests in RWAs. So especially if you have assets that you want to provide DeFi users, Plume Network is a great partner to consider. We're also partnering up with Jupiter, which is the premier exchange on Solana, to bring our DShares there. And we'll continue to support Arbitrum, and we're launching on Base later this year as well. But the overall vision, of course, is by bringing together market makers, gotta go back. Market makers here, DeFi partnerships through various protocols there. The blockchains like Plume and the others that we're working with, and the issuers that we've partnered up with, we are able to essentially work together to bring these RWA tokenized assets to the world in the apps that they're already at. Which we believe is the best way to actually get the biggest audience of investors available for something like this. So ultimately, with Solid Violet, what was once specific to Denari and just Denari assets, we now want to open up to other trusted issuers of RWAs, whether you're tokenizing funds, whether it's real estate, commodities. There's kind of a whole world of app users out there that want access to them, and you can do so through our network. We're going to do this in a sort of a staged way and in a stepwise way, where we're going to start partnering up early with some of the issuers this spring, and then sort of the more formal launches will happen in the fall and the winter. At least at launch, not all issuers will be eligible to be part of our network, as we're working with a few, I think, most trusted asset tokenizers in the space. I think this is really important because the access to tokenized assets is one thing, but more importantly, the visibility and sort of working out how to surface the assets that users want most is something that we're working on with our partners right now. So we've had a lot of inbounds from issuers wanting to access this network. We're trying to work out sort of the best way to prioritize the right partners to do this in terms of the launch right now. And kind of a fun way that also makes my earlier point to do this is we will be enabling sort of an access to our platform token, and through the platform token, our API network will be activated for issuers that are really interested. So to that end, again, to sort of make the point of the wallet login process and things like that is still a difficult process. We want to make that point and simultaneously weed out issuers that are not serious about sort of working with us and things like that. So if you're interested, you can actually go to this QR code. There you can actually stake either staked ETH if you have them, or later this week it'll be normal ETH as well. And if you can figure out how to do that, kudos to you, and I'd be happy to talk to you a little bit more about being a launch partner with Solid Violet in the fall, so that we can get you access. The amount doesn't matter, you can take it out at any time or something like that, but it's just kind of a fun exercise to do if you are interested in being partners with us on the network. But ultimately, through our licenses, novel technologies, our API distribution network and partnerships, we hope to accelerate the trading of RWA assets more than ever through a whole army of apps rather than a single one. It seems like every issuer is now wanting to have their own app. Basically, it's just not the most efficient way of doing this. And so we are sort of batching them all together through our API network. And so whether you're an issuer of RWAs, a chain, a market maker, or even building a dApp, there's a place for you in the Solid Violet network. And so I hope that you will consider joining us. Thank you.
why don't we take these three? Okay, cool. This one? Okay.
Oh, yeah.
Good afternoon. Thank you all for making it back from lunch. We are the Tokenized Fund panel. I'm Todd Zariga. I'm a partner at the global law firm of Morgan Lewis, where I assist funds and issuers in tokenizing their funds or securities or commodities. I am joined today by Miguel Kudri from L1 and Kumar Ujwal from 12Fi. So, Miguel, can you please introduce yourself?
Of course.
Tell us a little about what you do.
Yeah, thanks, Todd. Great to be here. So I'm Miguel Kudri, co-founder, CEO of L1. You might have heard of us as L1 Advisors. We just shortened our name recently. Essentially, L1 is an operating system for on-chain wealth and asset management. So we're building products for essentially financial advisors, wealth managers, and asset managers to work with clients who hold crypto in self-custody, who hold the underlying asset, and leverage basically the entirety of the DeFi ecosystem, protocols, tokenized funds, and all the good stuff that we've been discussing in the last couple of days.
Hello, everyone. Thanks for joining us. My name is Kumar Ujwal. I'm the founder and CEO for 12Fi. We are also an asset management software, but we focus on the DeFi, not DeFi, RWA section. And our goal is to how to bring real-world asset on-chain. It's more like asset agnostic. Initially started with real estate. That's where the name Dwell came from, 12Fi. But now we are asset agnostic. So we have tokenized different type of assets on-chain.
Great. Well, let's start with tokenized funds. And Kumar, you had mentioned to me that you were recently involved in tokenizing a $120 million real estate fund. So could you walk us through kind of what that was, what your challenges were with that, what the success story was with that?
Yeah, absolutely. So yeah, we recently tokenized, not recently, it's been almost a year now. We tokenized a real estate fund which held $120 million of total of real estate assets across roughly 700 LPs, all traditional LPs. So if you think about the tokenizing an existing asset fund, there's a bunch of challenges in that one, starting with like regulations, then onboarding your clients, LPs. But there are technical challenges, there are regulatory challenges, but I would say the most challenging part is how to bring traditional real estate people to something they have never touched and seen, which is tokenized fund. And then having that experience to day-to-day interact on the blockchain, that is the most challenging part. So given the time, I will just focus on that part first. So when you look at a traditional real estate investor who have never touched a wallet, have never thought about, like, ever seen a digital token, neither know to maintain those things. And at the same time, you have like such a bad impression about token and crypto in the traditional world. People are always scared about like how it will work. So one of the ways we have solved that challenge is giving the interface to the users where they interact with their blockchain is absolutely Web 2 experience. So they never touch and feel like, think about this as a token, but all your blockchain is in the backend. So to do so, we have built something, self-custodian MPC wallet, which keeps stored their tokens, and we call it digital certificate, those tokens. And then the way they interact is they have in a traditional email. So they don't even have to manage their keys and all those things, which is done in the backend. So that experience is very important because that's step one, or I would say step zero, for a non-crypto native person to bring into the crypto world. Once you get there and start interacting, then you slowly educate them and give them how to interact with a wallet, how to do a transaction on chain, still all on Web2 experience, but slowly, and that's how you educate and bring more and more people. So that was one of the most challenging thing, which took us like 6 months to educate people and start using it. But now we have over 6,000 transactions has happened on that chain, which is all on 100% on chain. Yeah, I would say that was one of the big challenge.
Miguel, what is L1's involvement in tokenized funds, and what kind of vision do you see for tokenized funds?
Yeah, so I think there's a big theme as I've listened to all the great conversations today and yesterday. There's a lot of builders out there tokenizing funds that already exist off-chain. We're seeing novel crypto-native funds also being created. And there's a commonality between all of them, and it's the fact that they all need distribution. So I think, the market today, if you exclude stables, we're talking about $7 billion, which in the grand scheme of things, it's a very small market, but is a proof of concept for what's possible. And so who are these funds, tokenized funds, targeting today? I'd say they're targeting the crypto-native individuals who are already on-chain, who already have funds and have gone through the quote-unquote pain of learning about all the things that you need to learn about to get access to these funds and assets. And so that's the primary customer. Naturally, that's who we actually built L1 for to start. And in the process, as we built out tools for financial advisors, for wealth managers, for asset managers, we discovered a very important need in that market, which is, RIAs in the US control over half of all US wealth. That's over $50 trillion. And within the tools that they use, there's a lot of pain in allocating to different types of asset classes. And so when you kind of dive into the process of a registered investment advisor to invest in, let's call it a private credit fund, you start to kind of see the potential and the opportunities for these tokenized funds to address some of those pain points. And so I think that's the secondary market, which is ultimately going to be much bigger than anything that us crypto natives have kind of created. But there's still a lot to be built and created. So earlier we had Carlos from Securitize. L1 is integrated with Securitize, so you can go to L1 and access any of Securitize's tokenized funds, including BIDL, and you now start to kind of bridge really the on-chain and off-chain world. And when I say off-chain, I mean RIAs, family offices, and anybody that wants to tap into these assets. And so I think we're going to support more and more of these tokenized funds and products in general. And we're building the infrastructure to bring in those $50+ trillion in assets, bring in the allocators into the picture, and hopefully give distribution to all of these projects that we've been hearing from.
Yeah, and both of you hinted on what I think are two of the biggest challenges, and that is, one, how do you bring scale to the investor base for these tokenized products? As some others mentioned yesterday, they're basically, most of these are in walled gardens, right? Which limits the distribution, but there's regulatory reasons for that, right? And then Kumar, I think you touched on the other challenge, which is kind of making it a good user experience, right? And how do you make it seamless so people don't know, that it's even tokenized? So maybe talk a little bit about what you're seeing to address those two challenges, and maybe where you see the market moving.
I mean, I have some thoughts to share since I talk to RIAs every single day, and sometimes it's painful to hear how they describe their operation. And they tell me that it's painful. I recently spoke to a 700 million RIA who has 7 different custodians. And he was recently switching his billing model from AUA, percentage of AUMs, to percentage of net worth. And to do that, he had to do all these things because he was dealing with so many different custodians. And so in the traditional world, you talk about walled gardens. That's what these custodians create. Today, if your securities, if your money is sitting in a custodian, you only have access to the walled garden of this custodian. You can't just look at something that your custodian doesn't have access, or worse, that your custodian doesn't allow you to access, or they don't believe in it. I mean, we've seen it recently. I won't name names, but when the entirety of the industry is really built on these custodians, naturally silos emerge, and so that makes everybody's job much harder. And then the person that actually pays the price is the investor, because you have to pay fees. We know all the layers that are involved. And so when you come on chain and you get the closest that you've ever been to the asset, and the closest that you've ever been to a derivative or a financial product or a service that uses an underlying asset, you're naturally at the same level as everybody else in the space. So you're no longer limited to anybody's platform or ecosystem. You plug in, you bring your own wallet, and you get access. So, I mean, I think, as you mentioned, the regulatory piece is kind of a problem that is stopping a lot of innovation. But I think we'll get the guidance and the clarity hopefully soon to just keep building.
Yeah. So if you look at one of the big challenges in the walled garden is, as you talked about, is custodian. But apart from custodian, you also have the assets. Because of the regulatory reasons, if you are in a private fund, you have a certain rules. There's a lock period. You have to stay in that. And if it's a security, if you want to do the transaction with the security, you have to go through the KYC. All those things is there. So by default, you have to have some kind of walled garden around that. But there's ways to take those assets and move into a truly DeFi way. And those are the certain innovations which is happening right now. And you will see in this next cycle, there's a lot of projects coming in which are focused on those things, and which are basically, when you take an asset and you tokenize it, truly tokenize it, that means you take 2 parts of that. One is your LP interest, which represent who owns what actually on the cap table. That goes on chain. And second, when it's what, that is the asset. And what is the value of that asset? That value of the asset is represented in the data, underlying data of the asset. That is encapsulated in that same token. So those 2 parts of the token goes on chain. Now, once it goes on chain, it's truly first encrypted because it's on public chain. You cannot read it, so there's certain information is available, and the rest is encrypted. But now, when you want to take that asset and go into the DeFi world and want to truly leverage the DeFi like lending protocols and all those things, you still have the problem because these digital securities are actually a securities. So they have to have a KYC, AML, all these things. So to bridge that, that's where the ZK proofs comes in the picture and ZK snarks. So you take those assets, then you wrap into a ZK proof, and then once it's wrapped into ZK proof, then it moves on-chain, still on-chain, but the DeFi world, where you can anonymize and then do the transactions, but still it's verified. And when it goes back to this, again, the walled garden, you have those the KYC, AML, and everything is in place. So these things are in progress. There's a bunch of projects going on, and you will see soon there's a lot of adoption in the ZK snark world.
Yeah, just so that is zero knowledge, right?
Yeah, zero knowledge.
Okay,
Zero
and
knowledge proof.
that's similar to what we were discussing yesterday, where we're in need of basically a KYC that goes with you.
Yep.
Right, and that is
Exactly.
a common standard that can interact across the gardens, so to speak.
Yeah, so if you look at the KYC, generally these are standard. The reason why the providers are different, like Clear is one of the providers. You can have the Plaid is one of the providers. But end of the day, the underlying data, which is used to create KYC and AML, those are standard. So driving license or your passport and all, and then OFAC list for the AML, those are the standard data. Once the entity which verifies this data are different. But once you have those things, then you can wrap into a ZK proof, attach with your token, move into on DeFi world, you can do the transactions.
It's really permissioned versus permissionless. A vast majority of DeFi has been permissionless, and I think DeFi purists are always going to go with permissionless protocols, and KYCing basically just gives you permission to access certain products. One of the benefits of on-chain protocols and DeFi in general is the composability aspect, the fact that protocols can just build products and derivatives, and they can wrap tokens and assets, and you can just stack multiple things together and create something completely new out of the combination of their functionality, and you don't need permission to do that. Now, when you introduce securities, or tokenized securities, by law, from regulations, you're going to have to be KYC'd, and so somebody needs to grant permission. Today, there's a lot of people trying to grant permissions, and there's no single party. We, as integrators, have to integrate with different KYC providers. We don't do the KYC, the issuers, the broker-dealers. Those are the entities KYCing, given permission. I'd love if there was an entity or a public resource that can become the standard. Many people say that's going to be or could be the Ethereum attestation service. I think we're definitely moving into that direction, but yeah, standard is needed.
Mm-hmm. The additional part of portability also goes to the wallet, right? And so whether you have a self-hosted wallet that you can port with you, or whether you're relying on a hosted wallet. So maybe, Kumar, you mentioned on the launch of your real estate fund, I believe you indicated you used self-hosted wallets. So maybe walk through, and you mentioned, I think, the email component of that, but walk through what the thinking was in using self-hosted wallets, and what the challenges are of making that a seamless user experience.
Yeah. So there are certain, when you tokenize certain securities, there's standard you have to have with a custodian, or you can have the self-custody. So that will be defined your fund structure, which fund your formation. So the standard we have used is 506C standard to tokenize that fund, and then in that we can self-custody those the tokens. So when you're doing the self-custody, the reason why you have to do self-custody is it basically gives the end user the ability to store their own tokens with themselves, correct? That gives the sense of ownership of your token, what you own. But at the same time, the security is very important. So if you can have a self-custodian wallet like MetaMask, correct? And then you can lose the key. What happens in that scenario? You lose everything, correct? So it's a kind of a hybrid approach where you have a self-custodian wallet, which is, so when we onboard our clients, we provision a self-custodian wallet in the backend. That wallet keys are distributed into a GP-LP structure, and the third is in the cloud. And then the way they interact with that one is you don't have to maintain the keys, but you interact with your email address. So that's like a natural way to the way you use today, like any login password, you go through your email, or you put a password, but we don't do that. And then it generates a magic link through which you can interact. Now that gives a very seamless user experience where you can interact with your wallet, and then you can do transactions on the top of that. Plus, it allows you to manage permissions on your wallet, which is also a critical part when you are basically an investor in a real estate fund or anything. Basically, when you are an LP in a fund, you generally work with your accountant, legal, lawyers, and all those people, correct? Now, those guys need to have the access to your wallet because your assets are stored there, correct? How are you going to enable them? you're not going to give the keys and all those things because they have never used it, correct? That's where you have the permission where you can go into your wallet, add permissions based on the email, and then they have a certain permissions which they can do, what they can see, how they can interact. And that's the easy, seamless way to basically bring non-traditional people to crypto world, although they are not seeing that's a crypto, but still they're getting all the benefit of blockchain.
Miguel, you want to comment on the self-custody?
I mean, yeah, self-custody is what we do. I think self-custody is just going to get easier and easier. Today, I mean, as Kumar mentioned, you can now just sign in with your email. There's Magic Link, which we use. There's plenty of new options for wallets to be spun up with an email sign-in, single sign-on, and I think just self-custody is just going to get easier and easier. I think we're 12 to 18 months away from fully abstracting private key management. Even with Magic Link, you should understand the concept of a private key, and they even give you the ability, as they should, of exporting your private key. I think. Yeah, I think we're very close to kind of Web 2, full Web 2 level of UX for wallet generation and private key management in general. Ultimately, self-custody is the closest you can possibly be to your assets. If you're working with a qualified custodian, they are all they're doing is they're holding your private key, and so that's just a layer between your assets and the access that you have to those, on top of everything they of course offer. But if you want to do anything on DeFi rails, if you ultimately want to do something with your tokenized funds or any sort of tokenized asset, you're going to need to, at some point, be in self-custody, whether you realize it or not. It might just be that you're signing in and doing a just-in-time funding out of your Coinbase account or some other exchange, and you're funding a self-custodied wallet just for that transaction, but you're ultimately going to be using self-custody. And so I think that's where we're going. I think that's also going to change the industry, the wealth management space, the asset management space. It lowers the barrier as an investor to switch and try a new service provider, whether it's a financial advisor or an asset manager. I think it brings transparency, visibility, competition, and so ultimately the investors benefit the most.
Yeah, I've always, in self-custody, I think there's a big education lift for the casual investor, and I think that's part of the challenge. I mean, even for myself, who I consider myself to be very literate in digital assets and crypto, I don't pretend to know the nuances of self-custody. And I just wonder, is it an education lift that's needed, or is it showing increased functionality? Then investors are going to go there, not because it's self-custody per se, but because it has a lot more usability, maybe across platforms.
I think it's definitely the latter. I mean, people should not need to care about what self-custody even is. It should just work. And I think it's our responsibility, everybody in this room that is somehow involved in this space, to just abstract all of the needs for education away from everyday users. I think people that work in this space should know what they're getting their clients as fiduciaries. They should know what they're getting their clients into. But as an investor, I shouldn't need to know. And I think to a certain extent that's already possible in many types of products. Like we have already been seeing onboarding of non-crypto native clients from our RIA customers. I think it's more prevalent in the kind of high net worth, ultra high net worth family office, multifamily office world, where individuals and institutions are looking for riskier products and higher returns, and they're looking for liquidity, and they seek volatility. And for those types of investors, there's a lot already that's been abstracted away in terms of complexity. For everyday users, there's still a long way to go, but we're not that far away from that.
Kumar, any?
Yeah, I think the education is one of the key, but as I said, like everyone, This is like a small community. We all are interacting with, we are the nodes which interact with all the people who have no idea about how the self-custody or the wallet and works. So that propagate that knowledge is important. And then bringing when the people are coming to digital world, I would say the gap between how you interact with a wallet, because wallet is like the first step. If you look at from a Web3 perspective, wallet is your browser for Web2 world. So everyone has to go through that, correct? So how seamless that interaction could be, that is the best way we can bring more and more people in this world. So the education, experience, all these things are important.
Before we move on the scale point, and I think it's been mentioned a couple times already this conference, but one thing I think of is, okay, if we have the technology and it's a compelling technology, that's great, but we still need compelling products to drive demand on the rails, so to speak. Any thoughts on is this a chicken and egg thing? Once the rails get more user-friendly, once the investor base gets bigger, the products will come? Or is it the other way around where we need compelling products to get the rails going?
So I'll take on this one because we have seen this. It's, as you said, it's chicken and egg problem. Absolutely, yes. Sometimes it starts with that, okay, where is the product, where is the people, correct? But the way to solve this is when you start with an existing fund, which is already people have invested, now move that fund on chain. That's where you solve that problem, chicken and egg problem, because you have asset, you have user. But now, why they should move on chain, that is where the question is. Like, what is the value they're getting? Because otherwise, yes, you can be off chain and everything works well, correct? So that's the true value proposition of on-chain need to be provided to the users. So then they stay there and see the value, and then they come back again. So for those things which we are doing is, what we have done is two things. One of the big issue for in large funds for the users is how to exit. When you are in a particular fund, you invested, it's like locked for 7 years or 8 years, depending on the fund life cycle. It's very hard to exit, correct? So the other way, generally the traditional way thought was, okay, you can take this, tokenize this fund, connect to an ATS, and then it can trade. Yes, it can, but there's one big missing piece in that. One is, because these assets, generally, you only tokenize those assets which are illiquid. Because if you're a liquid asset, you can trade it. Why you have to tokenize it, correct? So if you take an illiquid asset and you tokenize it, then connect to the ATS, the problem there is, these illiquid assets are inherently volatile assets. They don't change the price daily. Now, because of that volatility, there's no volatility, there's no market maker, because the market maker has no incentive to come there and then clear the market. If they will not clear the market, there will never be more trade happens. And that's the reason why, so far, none of these tokenized fund has been trading that much. Now things are happening, correct? So the second approach to think about is illiquid asset, how you can bring liquidity while they are on chain so that people become more attracted towards those illiquid asset and tokenized asset. So the second way to think about is it should be tokenized, so you should be able to borrow against those assets like you were doing in a traditional world. But the problem is, if you go look into the traditional world, like a HELOC product, you're a home, you can borrow against your equity. Why you can do that? Because the value of your home is universal. Everyone knows that, correct, in the market. But if you take a private fund and you want to borrow against that, that value of what is the underlying asset and what is the performance, blah, 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 all those things are unknown. So that is the big problem. That's why you cannot go in traditional bank and borrow. Yes, there are boutique banks and does that, but I'm talking about at scale. That's where the tokenization, true value of the tokenization comes. So when you take those assets and tokenize in a true fashion, that means you tokenize the asset, equity table, who owns what, and the asset data, and put it on a public blockchain, but in encrypted fashion that's not available and still respecting the privacy. And from there, when you enable those two lenders and bankers, which they can do the underwriting. Now people can borrow against those assets, correct? And once the borrowing enabled, that means you have brought liquidity in those assets. That is true value of tokenization. That's why people will come and start using it. So that's the one way to bring value add in these tokenized asset where people will come. So that's what we have done. This was a learning for us over 3 years. This is eventually we went through all the process, and then eventually we launched tokenized. So we first tokenized the fund, and then launched a liquidity pool of $30 million to people to start doing this, borrowing against that. And we are seeing a really good response from the people. So that's what my experience was.
If I can add to that, I love the example, and you mentioned liquidity, and perfectly put, liquidity begets liquidity. At the end of the day, the fact that these traditionally things operate in silos, it makes it much harder for organic liquidity to exist, and it all depends on market makers. I think one of the greatest innovations of DeFi is our automated market makers. The fact that any one of us here can be LPs and can be market making any asset. And that's something that financial advisors don't see. When I explain this, most of them, when I explain this to them, they're mind blown, because they don't ever make the connection between their clients and their clients' holdings and the fact that those are just sitting there doing nothing. Somebody else is market making. Somebody else is borrowing those assets to generate billions and billions and billions of dollars of market making revenue per year. And for the first time, we can decentralize market making. And so that creates a network effect that is just not possible in TradFi. The fact that the more people that invest in a tokenized product or asset, and the more people that can participate in these automated market makers and pools of liquidity, and the more yield that these people generate. And so it's a very nice flywheel, because people talk about it. People love yield. People talk about this stuff, and this is what actually is going to get that organic growth. So yeah, that's liquidity begets liquidity.
And it's, one more thing I would like to add. This is very challenging when we start, because as you said, RA and traditional finance, they don't understand this. And we have experience, because when we started this, we talked to several banks, and none of the banks understood exactly what we were trying to do. And then none of them were ready to participate in the liquidity pool, because it was like, you still have to go through a traditional way, which doesn't work in this one. So eventually we have to start our own liquidity pool to start the first pool to basically do this transaction. And then now we're seeing other people getting interested in coming in that pool. So yes, always there will be an educational gap. There's a bunch of these things where you have to start something, and then people will come.
Yeah, just to bring it full circle on the education point, the more I hear your comments, the more I think the education is not so much on the technical aspects of what's going on, but it's more explaining what the benefits of this is, right?
Exactly.
So in my world, which is more fund-based, there could be benefits to the issuer of the fund, right? There could be benefits to the shareholder. For example, peer-to-peer transfer instead of redemption back to the fund. But by the way, that's a benefit for both the issuer and the shareholder, right? And so the more I think about this, it's really how do you explain the benefits of all this and get that out into the marketplace.
So the way you explain these benefits is actually going through their pain. So what is the pain point, and then how you show those pain points is solved on chain. So two basic example is your LP being locked into a fund, and then if they want liquidity, they have to generally give up their liquidity discount, and that's how they get out. But now, if you are a tokenized fund, you can do equity swap on chain easily, and that is easy way to basically someone want to exit. Plus, not just exit your whole position, but you can actually exit a fraction of your position and still hold it. So those are the things which actually people have pain, but now you can do it smoothly on tokenized fund. That's more than education. That just gives them the understanding exactly what is the value out of that. Similarly, having the ability to borrow against your asset, do not have to sell your asset and then pay capital gain on those things. Instead, borrow against that and write off those interests which you're paying on the taxes. Those are the real benefits. And then once people start seeing it, that's where they see the value of the tokenized fund. And it's from one fund, one GP to the another GP to another GP, and one LP to the another LP. And that's how you propagate this whole message.
Yeah, and in my world, it's similar to kind of the rise of exchange-traded funds, where they really added an additional layer of liquidity for both shareholders and for the issuer. So the issuer doesn't have to maintain cash balances to fund redemption requests. So it's a real innovation because it's good for both the shareholder and it's good for the issuer in the management of the fund. You know, I see a lot of similar benefits in tokenization, right? And maybe it's the next step from exchange-traded funds. But in my world, I see a lot of parallels.
Absolutely.
So in the last 9 or 10 minutes we have left, I wanted to pivot a little bit. And Kumar, I'll start with you, but you had made an interesting note about, so when you tokenize an LP interest, you're just tokenizing the share, but any subsequent purchaser will need certain information with respect to that investment, right? What the past performance was, if there's distributions. So talk about how that would work in a future state where you have a peer-to-peer transfer of an LP interest. Okay, they got the shares, but how do they have access to all the underlying information that goes along with holding that LP interest?
Yeah. So there's a this also comes to the same thing like as in crypto. There is a path to get to a true sovereignty, a true DeFi state. But if you look at the traditional funds and you want to get to a truly DeFi, there's always a barrier because of the regulations. You can't do that. So it's more like a hybrid approach. So the approach is that when you tokenize the fund, you tokenize not just the LP interest, which is representing who owns what, but also the underlying data of the fund. Now the question is, when you bring the underlying data, that is a little bit messier work because that data sits into multiple silos today and sits with your administrator, sits with your CPA, a bunch of tools, correct? So, and mostly in unstructured format. So you have to bring that data from all the sources, convert into a structured format. Then you have to store that data on chain in a more like a encrypted way because it's on public chain. So it should be encrypted because it's the private data. So all these things are possible through the technology and is done today. But one of the things which people generally ask in this thing, like, okay, you take this asset data, which is 100% on chain. Now you have two type of data. One is your underlying asset data and the LP interest data. You combine it, encrypted it, put on chain. But now how you verify this data is that this data is true, correct? That's one of the challenge. And if you look from a DeFi or true crypto native perspective, then there should be some kind of an oracle system, correct, to verify those data. But that's where the difference is, why it's hybrid. Because this oracle system is not required in a traditional fund. Because in the traditional fund, your administrators, your CPAs, your accountants, those are the oracle. Act as an oracle, not a true oracle. Because they are the regulators who has to go through this, comply with your data, and then give you the data. So when you get those data from that source, you don't need an oracle system. And then you basically encrypt this data, put it on chain, and make it available for that transfer, equity swap, or borrowing, and all those things. So that's the hybrid approach. Yes, maybe in the future, there will be a day when everything will be truly on chain, and you don't need the oracle. This happens on a sense like if you have underlying assets like crypto native assets like Bitcoin and all, then you do the transactions on chain, and that is truly on chain. For the digital assets, you don't need that. You can pull all the data from chain and keep it on chain. But for non-crypto assets, you have to go through that.
Mm-hmm. Miguel, anything else on the kind of administrative side of this?
Yeah, I mean, what Kumar just explained is exhibit one for why we don't have instant settlement in TradFi. I mean, it's absolutely brutal, and why instant settlement and crypto native tokens and funds are so both disruptive and interesting because they enable full openness and transparency into how things are operating in real time. You don't have to trust an accountant or an auditor to say that what is on the financials is accurate. And then on the flip side, if you're an advisor, if you're an asset manager, you can start looking at on-chain fundamentals and real-time data that is going to inform your practice and your decisions on what to do and what to recommend to your clients. I think, I mean, going back to education, I think a lot of, every financial professional really is going to have to learn how to operate in this new environment. As much as we like to go home when the markets close and not worry about it, even if some markets that come on chain are not like fully 24/7, I don't see it happening. I think we're inevitably going into that direction. But even if that happens, data is always going to be available almost in real time, and we're heading there. It's not possible today. There's a hybrid model, but it's an area that we're all going to have to kind of learn how to operate in. And again, ultimately, the main the person that benefits the most is the end investor, because they get to see performance in real time. They get to see where your money is, really. Like if you work with an investment manager, you can see their performance, you can see their track record, and there's no need to trust a third party to make up your mind and make a decision.
Yeah, and I would be remiss as the attorney on the panel to not bring up the transfer agent aspect of peer-to-peer transfers. If you're a registered mutual fund, and WisdomTree was up here in a prior panel, they have 11 mutual funds that are tokenized, but under the securities laws, you need a registered transfer agent keeping the ledger of the mutual fund. Private funds, there's a little more flexibility, but you still, at the end of the day, need somebody maintaining the ledger of who owns the fund. And so that's another added complexity in terms of the administration of funds on chain. Okay, we have 3 minutes left, so I just want to maybe ask each of you to maybe provide where you see the tokenized fund market in, say, 18 months to 2 years from now. Like, what's different from today?
I can start. I think we're going to see kind of game theory playing out in the next year. You still have a lot of players on the sidelines waiting to see what others do, and you're already seeing kind of those dynamics at play. In the process, it is highly experimental today. So the institutions that are playing in the space are going to be targeting those investors who are already in the space, the crypto natives. But as other firms jump in, I think we're going to see, and behind the scenes you have infrastructure and scalability and all these improvements that we're all working on to make this thing actually scalable and to make it work. But once these other firms start coming in, you're going to start seeing products being created that are not only crypto native, but that are only possible on chain. And that's when the light bulb is going to go off with the traditional allocators, and they're going to see products only available on chain that they can't get anywhere else. And it's going to be the clients that say, hey, I need access to this. How am I not, and my friend is, and I'm going to switch advisors, or I'm going to switch asset management firms. So that's going to play, in my view, in the next 12 to 18 months.
Absolutely. So we're already saying that a lot is happening in this space, especially with the Bitcoin ETF. Now, more like traditional people can have access to this one through the ETF. So that is already creating an awareness about the digital asset. And what we are seeing from our side is a lot of funds, as you said, experimenting. So they all are starting with like a small fund, and they're one of the GPs who are interested in tokenizing. Everyone is trying to experiment with this. That gives a clear picture that where the world is going. Yes, there is always a up and boom cycle like bull run and winter, which will again happen, but this will not stop. As every cycle, more and more funds will be added, more and more traditional people will join. But then there are two things which I think is going to happen, which is not clear to me right now how it will play it out in the future. One is a public blockchain versus private blockchain. So because of this traditional finance and large institution like JP Morgan and all, they have their own chain, and then they're bringing more and more assets on their own chain, versus their public blockchain, and then traditional funds are also coming on the public blockchain. So it's hard to say like what's going to happen in the future, who will win, or it'll be some common theme. Hard to say right now, but that's definitely going to play out.
Yeah, I guess my one semi-prediction is I think we'll be talking a lot more about tokenized funds 18 months from now than we are investing in cryptos through traditional ETFs, right? I think a lot of the narrative in the first part of this year, rightly so, because it was 10 years in the making, getting Bitcoin ETFs through has dominated kind of the discussion.
Great point.
But I think in 18 months we'll be talking a lot more about tokenized funds. So,
absolutely.
Well, Miguel, Kumar, thank you so much, and thank you.
Yeah, thank you for having me.
All right, everybody, welcome back. I don't know what number panel this is, but it's been a great 2 days. We're pulling it up towards the end here. Let's finish things on a strong note and kind of close it out before the cocktail hour. I'm Peter Gaffney, head of research at Secure Token Advisors, our consulting group, as many of you have probably heard or are aware. We have today the Institutional Payment, Rails, and Settlement panel. My pleasure to be joined by Leo Mizuhara of Hashnote, Prakash Neelakantan of Broadridge, Aaron Ray of Zero Hash, and of course Jason Barraza, also co-moderating with me from Secure Token Market. I'm sure everyone very familiar with him as well. If you want to just go down, and Leo, if you want to tell us a bit about yourself specifically, about your firm, just to give audience good context, and we'll go down the row.
Sure. Nice to meet you all. I'm Leo Mizuhara. I'm a 17-year, I guess, veteran of traditional finance. Worked for DRW previously right before starting Hashnote with DRW's backing. Hashnote itself is a on-chain first asset manager. So we focus on all things that are asset management that can really be accelerated with tokenization and other on-chain activities.
Hi, I'm Prakash Neelakantan. I work for Broadridge. I drive actually at the corporate level our digital asset and blockchain strategy. Broadridge, for people in the capital markets world, they would not need an introduction. They would know us. But for people who are not familiar with us, we provide infrastructure for everything from trading to post-trade settlement services for banks and brokers. We also actually provide investor communication services and governance for most public companies in the US. So that's our two core businesses, actually, what we call trade operations and investor communication services. And we have been using blockchain technology or experimenting with it for maybe 8, 9 years now. And we work with private blockchains, or permission private blockchains, because of the regulatory needs. And a few focused on a few specific use cases, I think, which I'll discuss some of them today.
Cool. Hey all, Aaron Ray. I lead sales engineering and tokenization rails over at Zero Hash. Zero Hash is the largest regulated crypto infrastructure provider no one's heard of. We power experiences like Stripe, Interactive Brokers, and have recently gone into the tokenization space by powering crypto on and off ramps, USDC funding to platforms like TokenizeThis and a few others. So excited to be here.
Awesome, guys. So as you guys can see, we have a variety within the panelists themselves. So that being said, there is an overarching theme. So why don't we start with, for example, repos. Tell us a little bit about the use case for repos being on-chain and what you guys think the opportunity is there.
So the repo markets are some of the largest markets in the world, actually. I think in the US, I think it's around overall 4 trillion, 10 trillion globally. We support many of the primary market dealers involved in that US Treasury repos. Right? When we looked at potential uses of blockchain and smart contract technology or distributed ledgers, we thought that there could be more efficiencies if there is a coordinated service actually which enables better workflows and efficient movement of collateral between participants. Repo, as you know, essentially is cash for collateral. And so we launched this platform, I think, around 3 years back, 2.5 years back, I would say. And today we do around nearly 100 billion volume notional daily, maybe around $1 trillion on a monthly basis. And what we do is we immobilize collateral at the custody level and allow the digitized form actually to transact and move efficiently, instantaneously. We still connect to traditional payment rails because there is no real cash on ledger yet. But that's the path that we would like to go to. And the goal is very simple: improved workflows, efficiencies, cost savings for our customers as they deploy this platform. And we support a variety of, we started with, to build a network from scratch is the real challenge, as always. And we had to, and banks are willing to invest if they get real benefits immediately. So we worked with inter-entity, what we call transactions first, approved the benefit, moved to bilateral transactions. Today we support, actually in a path to support sponsored repos, as they're called, towards the path towards cleared repos, which are coming in 2026. And also intraday repos have become more important for managing liquidity. So You have the same platform supporting different use cases of repos. But the essence is essentially that we integrate with the existing financial institutions' workflows. We didn't need them to forklift anything, change anything. Makes adoption much more easier.
Yeah, I think the repo use case is like by far one of the biggest use cases here. Collateral settlement in general is one of the biggest things that we can do quickly and more efficiently than traditional finance. I kind of want to shout out to the Canton guys. So like the private blockchain that he was talking about is actually Canton, which is made by Digital Asset Holdings, which is another company that got started from DRW. So I just like to point that out. But yeah, they're making a fantastic product, and there are places where there are regulations that don't allow us to use public blockchains, where you need things like Canton to be able to provide that level of service. So I think that's it's an interesting observation to see that there are sometimes requirements for different types of blockchains, and therefore this like multi-layer one solution is almost certainly going to be part of our future blockchain world. And in addition to that, this was special made to be specifically superior to traditional technologies, right? We can now settle faster when there is a digital cash available. We'll be able to do that repo transaction in a much more streamlined fashion so that we can do intraday repo, for example, in a way that isn't quite so kind of chaotic. Right now, intraday repo is kind of a bilateral transaction between banks, and it doesn't feel like a marketplace as much as it does on something like Canton. So we at Hashnode are actually also looking into using this Broadridge solution on Canton to do our repo as well. So really excited about that use case, and I think it's one of the best use cases to date in the market right now.
Is there collaboration on that directly between Hashnode and Broadridge in that case?
Not yet, but
not
maybe,
yet.
maybe soon, yeah.
Nothing yet. But we welcome participation actually from the buy side. And because that's what is going to grow the market. They are the largest providers of cash and collateral in the markets anyway.
Yeah, we're hoping to be the first buy-side firm kind of involved. I think right now it's mostly banks, like all banks pretty much, yeah. DRW did one clip, yeah.
DRW was involved, they are involved in trades, repo trades, especially in the intraday market.
And actually, speaking of DRW and the Canton network that you guys are referring to, you guys recently did a series of experiments on chain and whatnot through the Canton network. Are there any of those? Did any of those have anything to do with repos? And are there any operational savings that I know Prakash, you mentioned operational savings a little earlier? Maybe you can give us some quantitatives on that.
Yeah. So I mentioned workflow efficiencies, right? So that's one part. That's the operational savings, right? Typically, I think we see if customers are flowing around 100,000 transactions through the system, they'll save at least $1 million. Right, so for every $100,000, 100,000 transactions, they will save $1 million. Right, obviously you get the added benefit of capital efficiency, better rates. Right, all of those things are add-ons.
Does the size of those transactions matter? What is the size in those 100,000 transactions to get that $1 million in savings?
The size, you're saying? No, see, it's interdealer market, right? So I think that it's a bank-to-bank transactions. One is a collateral provider, other is actually a cash provider, and that's what repo puts both of them together, actually, right? But today it's primarily U.S. Treasuries. The collateral is primarily U.S. Treasuries.
Prakash, on the sponsored repo side, is there any interaction? I think like UBS, SocGen are a couple of examples actively doing that. I'm sure there's many more behind the scenes. So their clients don't need to interact directly.
No, because
with that whole process.
So see, as a sponsored repo, the banks, you mentioned two bank names, they stand in front actually as a prime or clearer in front of their customers. So they interact directly with the network. The end, so that's the model actually. But we don't mind actually more participants coming directly to the network.
And then that, let's say the $1 million saved every 100,000 transactions, like some of that gets passed either through to those clients, back to Broadridge, or to the banks themselves. I'm sure there's some breakdown there.
Obviously, the banks get the benefits actually, and they either they decide how they will redistribute it, and but it's benefit for all participants.
Another way to say that they don't pass it on, but that is actually why we're interested in the space. Typically when you leave money at a bank or when you have a bank money market, you are invested to some extent in reverse repo and in treasuries and in bills. But the intraday repo part usually doesn't pass through the clients, which is interesting. We have a money market product called USYC, which we use primarily as a collateral vehicle. But one of the reasons we're interested in using Broadridge is because we want to access that intraday market, which is primarily reserved for banks, in order to boost the yield of our money market product, that we really pass that yield straight through the customers. So that's one of the things that we think we could really improve in terms of collateral efficiency and the ability to provide interest-bearing collateral for clients directly by using this blockchain technology and accessing these markets that are usually reserved for banks.
Yeah, I think there is great value in actually leveraging these platforms for benefit of actually all new products. The problem is money market funds can be equivalent to cash, but the reality is actually the collateral agreements need to be repapered to accept them. And obviously that's a process, hopefully, and as things move forward, we'll have more and more of potential uses of that. Like I mentioned, we don't do atomic settlement because the cash rails is still traditional, but it's near real time, actually, in terms of existing cash versus collateral settlement. But we are planning, we look at it in 3 stages, right? Our initial work was actually all in workflow improvement and process improvement, which we have done. The second stage is obviously connecting to cash and ledger. And in the next few weeks, you will see some announcement from us of us interacting with different cash and ledger providers, whether it's deposit tokens or alternates. And obviously, the final point would be actually leveraging collateral of natively issued tokens actually on the platform. But that's a little further away as things forward come.
And speaking about this, Aaron, you guys recently integrated into TokenizeThis. Are you guys involved with BUIDL, or how do you guys power these markets? And what are your thoughts on treasuries, stablecoins, money market funds, liquidity products?
Yeah. So TokenizeThis integration is a really amazing one. They have a platform that allows tokenized funds to be accessible to retail investors, entity investors, and anyone that really wants exposure. So, don't want to comment on any fund in particular, but we are able to power any fund that TokenizeThis has through our funding rails. And by funding rails, I mean USDC funding, meaning an investor has crypto or USDC, and the fund needs a USD wire. So Zero Hash is able to show a deposit address, basically run the full life cycle of that financing directly into that tokenized fund. On the flip side, if someone wants to redeem shares of their fund, we can send crypto back on-chain to the end user who wants to now redeem their tokenized fund for their USDC back. So we see tokenized funds. Some of their top customers are folks that hold stablecoins and crypto today, and we're here to power use cases just like TokenizeThis for any other player in the space.
And from the press release, it was 24/7, 365, right?
Yep, 24/7, never goes down. Whenever you want your redemptions or investments, we make it happen. It's pretty cool because, in a regular money market fund, if you wanted to take your money out on a Friday for something else, you might not get those funds in your bank account until maybe Monday or even Tuesday with T+2 settlement. In our case, you could put a request that you want your tokens to turn back into USDC on a Friday, and you'd get that within minutes of making that request, all powered on chain.
Awesome. Aaron, great context there. Something we hear a lot about lately, I mean, it's been a while, but especially lately, a lot of the commercial money bank tokens, deposit tokens, bank-to-bank transfers, like intra-bank transfers, different divisions of the same bank moving, wealth around. What are you guys looking at in that space? Any of the 3 groups here on stage? Like anything on the banking side specifically for the transfers? Can we use USYC to power a lot of that, or do you think a lot of that is happening kind of behind the scenes?
Well, I guess USYC is primarily built for use as collateral at things like exchanges, at places where you do OTC trades. Like in traditional finance, normally when you post collateral, you expect interest back on that collateral when you post it. Somehow within crypto, we've decided that it's okay that Circle and Tether make all that money. So we're looking to really change that paradigm. As far as intra-bank transfers go, that should just be a ledger movement. In the case of a bank moving money within itself, right, that should be a private database. So whenever you hear something about a blockchain being used for a private purpose, you should be somewhat suspicious that that means anything at all, because that's really just a ledger movement internally, which is a database change. And so, like, I've not actually seen very many of those, but I have heard of a couple, and they always make me quite suspicious that they're using the blockchain name to like make a news announcement. But yeah, they would actually be more efficient using a normal database, and they're probably wasting money trying to make it a blockchain event.
I mean, it's just great in general to see this conversation right now anyway, just because when crypto first came to be, it is 24/7, banks aren't. Now banks are becoming more 24/7 with the Fed now and internal bank transfers and basically saying we can move money just as fast as crypto, and then crypto goes, we'll tokenize your money market funds and even add more utility. And instead of working against each other, TradFi and crypto are now almost working together in parallel to actually use the core technology and not worry about the speculation that often comes to crypto. So in a sense, we're almost forcing utility down now finally and bringing crypto to the people as opposed to bringing people into crypto.
Yeah, that's a really interesting point, right? I think, databases are 24/7, right? All this technology has always been 24/7, and the banks have really just been too lazy to let you move your money around on the weekends. And now that crypto is there to force them to say, hey, like, we can all do this money movement, what about you? Yeah. Now they're finally turning these things on.
There was even news that the New York Stock Exchange is trying to offer 24/7 trading. On Robinhood, I think you can already do that. And they probably got that idea from assets that already trade 24/7. So really cool to see it.
Interesting. And what? Yeah, I mean, in terms of the intra-bank stuff, I think a lot of it is like just test cases, right? I keep talking about product distribution to like private banking clients. So I think the buzz is like, how can we at least get used to this stuff with other divisions that we don't directly interact with? And that's probably where a lot of that's coming from.
Yeah, private banking clients, I think, have some pretty specific needs. In particular, when you're thinking of private banking clients, we're thinking of high net worth individuals, people who often have needs internationally. So crypto rails start to help a lot because most banks can't do just that internal transfer of money from their entity in the US to their entity in Europe, for example. So at that point, you actually do need to use blockchain rails. So I think blockchain rails are really big for FX and for things like remittances. One of our partners is actually PayPal, Paxos, and the whole PyUSD ecosystem. I actually think PyUSD is going to be really important going forward because PayPal already has that payments network, right? You can actually go to a point of sale and you can use your PyUSD from your app pretty much now. I say pretty much now, but I mean absolutely now. You can go and use your PyUSD. And that's always been the promise of stablecoins, right? The promise has always been instant payment. And then similarly for remittances, we've been talking about remittances for probably a decade. And yet PayPal has their company called Zoom, I believe, spelled with an X, not a Z, where they can do remittances via PyUSD. So some of these use cases are finally coming about in a way that they kind of feel like intra-bank things, but they're not quite. They do actually have to span across banks to be able to do these things.
And actually, with Zoom and what you just talked about, are there any savings that people are, like the everyday consumer is experiencing through those remittance payments?
Last time I did an international payment, I think I was charged something like 5% or something ridiculous like that. Like FX is stupid.
Wow. So Aaron, I want to look at your group for a sec. So Stripe, Interactive Brokers, TokenizeThis now. You guys are setting up payment rails, getting everyone on board with stablecoin, with other digital assets, to just say. Like, what exactly are you looking at in the tokenization space? Is it all getting that initial 0 to 1, just get people on chain, get the rails set up, or kind of a broader vision?
Yeah, no, good question. We definitely have a couple of really cool announcements in the next few weeks that we're excited to make. But really what we're looking forward to is what's going to be tokenized next. So we went from the top down, right? Tokenized the #1 thing, which is the US dollar, which with stable coins. The second biggest thing is probably US Treasury bills with the tokenized money market funds. Third biggest thing is probably going to be real estate. So we're happy to power experiences where someone with crypto wants to invest in tokenized real estate. And ideally, it's, we're pretty much use case agnostic in the tokenization space. We're able to partner with any type of RWA that needs to embed a bridge to move from crypto to the tokenized asset and back. And then we also have fiat rails as well. As a US regulated money transmitter, we're allowed to custody fiat, move it around where it needs to go, and help end users especially move in and out of tokenized assets at a pretty fast rate. So yeah, really just excited to see some of the bigger use cases that come to be. And I think right now we're sitting at almost 1.x billion in terms of tokenized treasury bonds. As that grows, we'll power more and more of the rails and probably end up powering most of them. So super excited.
Yeah, I think no matter, so this is what, institutional payments and digital rails, or digital payments and rails, if I'm backwards. But at the end of the day, like always looking at distribution, I think there's no shortage of potential products and prospective issuers. The real question now is, okay, where is this going to live though? Where, what's the target audience and what are you doing to connect to that? And that's really where I see a lot of this on this panel specifically about like where are these things going to lie? USYC. Copper is supporting it, right? On the collateral posting side, maybe distribution to clients, like I'm always thinking that way. Where is everything going to lie, and kind of branch out from there? So,
yeah, and even this week we've been hearing. Oh, sorry. Even this week, we've been coming up with new use cases and hearing other folks share their opinions. We've talked to a few funds where, because they're on smart contracts, dividends get dispersed almost on a daily basis, where most money market funds would disperse them on a monthly basis. Well, since they're on a daily basis, what if the end user wants to get USD every day or USDC every day as opposed to the token? Well, with Zero Hash, we could technically push USD to a bank account. We could push USDC out on-chain on a daily basis. So I think there's so many more use cases that we haven't even scratched the surface of yet that we're super excited to power.
Yeah, it's really interesting. I think the future of where these things are held is kind of an interesting question. We talk a lot about custody in our world because most financial institutions need some sort of custodian to help them hold these digital assets. That's one of the reasons why we first went to folks like Copper, BitGo, Anchorage, Komainu as our first set of partners, because we knew that institutions needed a place to hold these things. And then the second question becomes, so when we're using them, how are we using these assets? And one of the big use cases for crypto right now is trading. And for trading, we've learned in the last 2 years that we should not necessarily keep our crypto at an exchange, right? Hopefully everyone's learned that over the last couple of years. And if that's the case, the most logical place to hold them are places like Copper Clearloop or BitGo Go Network or Komainu Connect, possibly Fireblocks Off Exchange. Like these are all things that we're really thinking about as the next evolution of what the crypto market structure looks like. So we're kind of building into that future, saying, well, you should hold USYC as collateral because you should be getting interest on your collateral. But how should you do that? You should probably be doing that through one of these custodians or through one of these other tri-party-like agreements. So we've built everything kind of with that network effect in mind, with that ability to hold these in a more secure format than necessarily at your exchange. Although you're free to do that as well. I think what you said about the interest on something like a USYC or any other money market token being put out daily is a really interesting comment, particularly because we were mentioning earlier the BIDL fund.
Yep.
So you were mentioning that the traditional money market funds give your money out once a month, right? Which is actually what BIDL does, which is moderately amusing to me because I think that is an example of one of these places where people have taken the traditional product and taken it all the way through traditional rails and then tokenized it at the very end, which I think is a very bad model to follow. In order to be able to do things like you said, where you can pay that interest every day and maybe take it off chain and start to spend it, you really do have to start to think more first principles about how do I create this product where I can do these interesting things, where I can do these useful things, rather than going through all trad rails and tokenizing them at the very end. That's another thing I think about a little bit with like real estate as well. There isn't a whole lot you can do in the intermediary steps before that. So I'm not super confident on real estate tokenization.
I think what Leo mentioned just now, I think just to get a thought, if you look at the settlement process, right, and what the token issuance have been done, say some of the banks have done experimented with bond issuances, etc. Most of them actually just use the ledger as just ownership records. The actual servicing of the asset actually happens outside off chain, and then actually is distributed again back on chain, which is what you're talking about. There is a gap in that, and if you want to get to what Aaron was talking about, that really needs a fully encoded digital product, actually, which can be serviced on chain with obviously oracles providing external price references and all this stuff. And that we have not seen in the financial markets, traditional financial markets yet, right? But that's the next step. Hopefully over the next few years, we'll see as people get more confidence in these issuances to move to the direction.
I think this panel a year from now will have all these use cases, hopefully. So definitely looking forward to it.
We're working on a couple of those use cases, actually. So, you know, one of the hardest things to disrupt is going to be the financial market as it currently stands, right? So trying to put like bond payments on chain, incredibly hard. Like so many incumbent players who do not want you to like mess with their shit. However, I think a really natural fit for some of this, what we're talking about, of having all that servicing done on chain, are what I like to call like naturally digital cash flows or naturally digital assets. So I think of things like video revenues, music revenues, ebooks, podcasts, anything where you're selling an online good, a digital good, and getting cash flows off of that. That's a really natural place for us to plug things like this in. So you can actually take those cash flows directly from the use of the digital asset. You know, count out those views or count out those minutes that something's being listened to or being watched, and turn that directly into crypto payments. Send that through a smart contract, securitize it, maybe tranche it, send it out to the people who have invested in it. So I think that's coming really shortly. I think this because I'm working on it, but yeah, it's definitely coming.
And Prakash, aside from repo, I know we spent the earlier part of the conversation focusing on that.
Yeah.
On Broadridge's end, like you guys power, what, $8 trillion daily on the equity, fixed income, everything side. What are you guys looking at beyond that you're able to share, or even client demand? Like, what's exciting that you think you could really start integrating on that side?
So there are a few areas, obviously, where this can head to, right? But we started with this financing, securities financing problem of repos. I think that's got a lot of scope to grow, right? So we would like to expand the coverage of that more to expand geographies, right? All of that will happen over a period of time. Like I mentioned, I think it's key for us to have cash on ledger. So that integration, interoperability with wherever digital cash is available and enable settlement, I think would be the next phase for us to enable. You would have seen that we are also part of this RSM, a regulated settlement network that the New York Fed has initiated an experiment pilot, right? We are also part of that pilot experiment. So we are exploring all of these, see how best we can kind of put everything together. Like Leo mentioned, existing markets actually is very difficult to change, get everybody to change. There are too many players who will be impacted. And you know, while disruption will come, I think it'll be incremental. And I think our approach has been to kind of incrementally support change and bring in whatever the best tools available to do that. Right. Outside of the tokenization of anything else, yeah, it could. I think if tokenization of alts actually expand, maybe supporting that actually in our wealth platform could be an opportunity. But that needs more work. First, alts itself, actually, distribution in wealth is still a very small percentage. So even that needs to kind of expand, and obviously tokenized alts will be the next big problem. We don't see intermediaries vanishing, right? I think there's, in the morning session, I think somebody asked Jason from DTCC about that too, I think, right? Intermediation, I think what we are making is all players in the process actually kind of more efficient. And hopefully the benefits will be to the end investor, right, with all the savings out of that. I think legally changing structures. We work within the current legal and regulatory structure, right? Our products. So given that, I think that's the best we can do, right?
I think on the, on the disintermediation piece, we have a competitor in this securitization of digital cash flow space. They're more of a TradFi competitor. They can only do big deals because of how much it costs to do that sort of securitization in the traditional world. And we think we can save about 5% on like that whole servicing process. And we send that straight through to our investors. So our investors can earn 5% more than the other, like our competitor asset in that space. So I think this sort of thing can be very powerful across the board if we can find the right ways to service those assets, actually.
So I want to touch a little bit on blockchains, right? There's always the debate, public permissioned, private. I know that you guys are Broadridge, right? You guys are on the Canton network, right? So I'm going to get your thoughts. And do you think that capital markets will eventually get to public, or the permissioned ones absolutely needed?
I think that it all depends on regulation, actually, and also a few technical challenges, right? So one key thing we have to remember is actually nobody wants complete transparency. I think, especially in the institutional world, actually, when you're transacting and trading, right? Markets occur because of information asymmetry. And I think a fully transparent world actually puts so much pressure on kind of hiding that information even more, obfuscating it. So I think that's one of the problems of the public blockchains. I think there is a need for public blockchains for a variety of products, and they will thrive on that right now. But public blockchains don't provide actually confidentiality of transactions, right? So, and that's why we are using actually a private blockchain. And not all private blockchains do provide confidentiality. We are using a specific one which provides confidentiality, right? And hopefully that technology, those kind of enhancements will happen in public blockchains too. And when that happens, obviously that infrastructure will be leveraged because it will be lower cost adoption for everybody, right?
It's worth noting that public blockchains and privacy aren't necessarily in contradiction with each other, right? Canton is going to be a public blockchain. It's just a privacy-focused one. So one of the things that you'll find, and I'm going to mangle some of this, so sorry to the DA guys, but conceptually what they're doing is that it's a public blockchain where you can hide whatever information you want. And that information is on-chain, but it's encrypted, and then only certain people can decrypt it. And you can do that for pretty much any field or any information. And that's incredibly important for certain types of regulation, right? Like you can't give out people's personal information, or you can't give out what their mortgage details are. And so there's a bunch of like really big use cases where you just can't do it on a fully public, fully transparent blockchain. That's a major flaw in the way like some of the like big public blockchains work, right? So being able to do that kind of screening is incredibly helpful, and I think why a lot of people are starting to use Canton as their kind of public-private network or their privacy-focused public network. Now, fully private networks are a different problem, right? And there's a use case for those as well. Like there's no reason to have a fully public blockchain if you're doing a supply chain problem, for example. And so the only people who matter are the people in your supply chain. Right. But just having that general concept of like, our private blockchain is bad, I think is just, it's a way to rile people up. But, every tool has its use, and we just have to be careful about where we use things.
And to your point, Jason, see, there will be a lot of assets which are actually kind of tokenized and deployed in public blockchains. They'll increase over a period of time. At some point in time, even these private networks will need to interoperate with them, and that's already happening. Right? We have seen experiments done by Swift, I think, last year with Chainlink, a few other experiments. Even the ones actually that morning they were mentioning about Project Guardian involved actually interoperability, right, in some sense. All of those are actually stepping stones actually to going towards the direction. Like Leo mentioned, you can do encrypted transactions on public blockchains, right? But that still leaves a trail. Sometimes you don't even want the trail, but you want the benefits of shared synchronization of state. So it's an incremental growing space. ZK is also misunderstood by many people, right? There's a difference between doing roll-ups versus actually having true zero-knowledge proofs, which are computationally hard today to kind of do it in full scale. So a lot of these things will improve, and as they improve, I think we'll find solutions. And at some point in time, hopefully, we won't be talking about public versus private blockchains.
I mean, I think
that's maybe 5-10 years away. I don't know.
Yeah, I think there's also some fear with public blockchains of, if you're on a public blockchain, you have to hold crypto assets, and we all know with banks and certain institutions, they don't want to hold or touch crypto. So how can they use a public blockchain in the first place where having crypto assets on their balance sheet is seen as something that's not regulatory compliant? We probably need solutions in the space like some sort of gas station that Zero Hash could power where a third party pays the gas fees and then the institution just needs to sign a transaction so that they don't have to actually interact with the public blockchain and use it as a crypto payment mechanism. They could just use it for the technology and have a trusted third party handle all the fee mechanisms.
Aaron, that's a sick case to talk about. I was unaware of that. So thank you. And kind of to that point, I was going to ask, what's missing right now? You could make a wish list of anything, but that's something that's addressable right now with your group in that case. But even broadly speaking, just on the panel, like what's missing to really kick things into the next gear? If you had something that you could have done, within the next few months, like what would that be?
Yeah, I can go. I think some of the tokenization stuff is great. The technology is now finally being used. I mentioned this earlier, but dividend payments, right? Using tokenization for what it's meant for and be able to settle 24/7, 365 is a big one. Also having easier on and off ramp mechanisms for these tokenized funds where, there's a lot of tokenized funds in the space now, but I'm a retail investor myself. I still don't know what I have and don't have access to. And also an institution, right? Like there's institutions that are all over the world, especially in Argentina and Venezuela and other places that hold large amounts of crypto and USDC, but they might not have the accessibility yet to even a tokenized fund that's probably meant for them. So it's really just getting more exposure into the space as a whole and showing the investors and the funds that there's a way to connect them and bridge them together.
I think having too many, commercial bank money, digitized form, is going to be a challenge because that will again fragment liquidity. For cash management, it will become still a challenge. So I think that needs to be solved for. I think today's world it works. If it's a centralized issuer like USDC, it's fine actually because you can go through them very quickly to initiate it. But otherwise, that will be a challenge. So hopefully we'll have better mechanisms. I do not know whether CBDCs will come into play soon. Depending on the country, I think it will happen, right? But the US is a little further away, right?
Yeah, sorry. I wanted to spend some time thinking about that. I think I've got like different dimensions in which I'd want things to appear. The first thing that I think we all kind of think, but maybe don't say out loud is like regulatory clarity, and perhaps like less hostile regulation in general, right? The reason banks can't keep cryptocurrency on their balance sheet is not any rational reason, right? Like they've got incredibly punishing capital treatment for some reason, like worse than equities, which doesn't really make sense. So I think regulatory clarity is a big one, and I think that would unlock a lot of the use cases we have. Including digital cash, right? Digital cash would come immediately if regulatory clarity happened. In a completely different dimension, things that look like fraud proofs, things that look like really the ability to hard prove that certain types of contracts are not hackable. This is actually a thing that is doable, but it's quite difficult. And it's extra difficult in a Turing-complete language. But you can imagine maybe a limited scope language for smart contracts where you can prove that certain types of hacks are impossible. And that would be incredibly comforting for the financial world, right? So being able to do that sort of verification, like formal verification of your smart contracts would be an amazing thing to have instantly, probably impossible. yeah, those are the first two things that come to mind.
Yeah, it seems like a phased approach, right? I think phase one is let's go out and tokenize everything. Phase two is, all right, how do we move these things around, which I think the Benji token actually just enabled to be able to transfer these tokens. Phase three is how can I use these assets to potentially get a loan or actually do things that I would in normal TradFi but faster. I mean, today if you had a bunch of TradFi assets, regular assets, the way you would show proof of ownership is by showing a brokerage statement or screenshot of your brokerage statement. Whereas we all know with tokenized assets, you could easily just sign a transaction saying, I own 100 million of BIDL token or something. I think we're getting there, and it's a phased approach, but those are probably the use cases and experiences we all look forward to of being able to use these tokenized assets for what the future is really meant for them to do.
A wallet that doesn't suck would be nice.
Definitely. And I mean, a lot of this, at the end of the day, this is coming back, like the focus here on the institutional side. We need to make sure the actual existing legacy players are making good use of this and there's something in it for them, right? Like, this is all great as retail investors thinking about the wish list and what we need, but we also are kind of looking at it from a, let's just say a higher up level or a deeper level, the opposite of that. So that's something that's still being addressed heavily, still using, we've been talking about the private chain side, the public chain side. Like, it's baby steps to really figure out what works. I think Broadridge's repo was a slam dunk. I remember reading about that when it first came onto my radar in a field that, fights for basis points. Like, how could you ignore saving, even 10 bips on a transaction? Trillions of dollars on a daily basis, you simply can't ignore that. And there's a lot of cases out there. We were talking about, the mortgage industry. We were talking about just interest payments as a whole, daily streaming. Like, there's so much opportunity. It'll all come down really to the payment rails. How is the end user accepting payments? How is the actual servicer or someone in between, or the actual issuer kind of front man sending that out? So it all kind of comes back to the rails here. I know we only have a few minutes left. If there's any kind of parting thoughts from the crowd, or if we could do a Q&A, or Jason, if you have something on your end, happy to open it up.
Oh, let's open it up. Any parting thoughts? Otherwise, crowd, if anyone wants to yell out a question, feel free.
I can do a parting thought.
Please do.
I think one of the great things about this panel has been that everyone here is like talking about really serious use cases and how we can do things that improve things within finance. I think more than half the projects I see don't actually try to improve something that in traditional finance. They really think, how can I improve this in crypto? And the problem with improving things in crypto is that A, it's really low-hanging fruit. Like, it's kind of a low bar, rather. Not really low-hanging fruit, but a low bar. And if you're not improving past traditional finance, you're not actually improving the things in the real world. Because we should always be thinking, hey, as an investor or as an individual, I have the choice of doing all these things either in the traditional world or in the crypto world. So personally, I keep most of my money in the traditional world. I bet most people within crypto do too. So even though they evangelize this kind of debanked world, they actually don't talk the talk. They don't walk the walk, right? And you got to wonder why that is. It's maybe because they don't feel that secure keeping all their money in a wallet that can be wrench attacked away from them. But there are many other reasons as well. So we should always be thinking, does this do better than my traditional finance counterpart? And that's actually the metric that we always use in terms of if we're going to onboard a new product, if we're going to create a new product, how is this better, or why is this better than what we used to do in TradFi? And if it's not better, don't waste the energy to do it, right? You're not going to outcompete TradFi. They have more resources than you. They have a better product than you. What are you doing? So yeah, I just really urge people to think about the kind of global perspective of why this is better, not just the local perspective of would this be cool to have in crypto?
You mentioned that the USYC is an equivalent in the new industry to the money market. Am I correct?
Sorry, could you repeat that? Sorry.
Here, I'll bring the mic.
Is USYC equivalent to a money market?
It's similar to a money market. It's not equivalent. So it's our USYC. It's not stable. It is fully backed by reverse repo rather than a portfolio of treasuries and such. And it's mostly because we're there to replace collateral. So one of the reasons it's not stable, for example, is because if you have a stable token and you're holding that at either your custodian or your prime broker or your exchange, then one of those entities has to keep track of how much interest they owe everybody, right? As money comes in and out of probably their universal wallet for everybody, right? That omnibus wallet has to keep track of everybody's inflows and outflows and then figure out how much interest they owe everybody at the end of the day, or at the end of the week or month or whatever their cadence is. Whereas with our token, you just keep track of how much collateral is posted, and you can give exactly that much collateral back, and the value has accrued within the token, which makes it much, much easier to use than a stable token.
So you just said that a lot of people in the space do not use the digital, but they still use the traditional, right? Do you keep your money in the USYC?
So when we trade, we keep our money in the USYC because that's how we accrue interest in the collateral.
Now you're trading money, your money.
We made this for a trading collateral, not as a savings device, which is actually something we say to people all the time. I think as a savings device, you should keep your money probably in traditional finance right now. But for trading, if I want to get my money from exchange A to exchange B quickly, this is much faster and allows you to earn interest on that collateral in a way that you can't do with traditional finance, and you can't do with the digital equivalent, like the stablecoin counterparts either.
Any parting thoughts? Oh.
You mentioned use of formal verification of smart contracts. Where do you see that's value, and where do you see the responsibility for bringing actual verification to the process?
Yeah, formal verification. Okay, so yeah, for these sort of things, I think, so from the math world, right, formal verification comes up a lot. From the smart contract world, like I think if you have a limited set of things, being able to prove that something is unhackable or that you cannot get funds out of a smart contract without certain conditions can be super valuable, right? And that can be part of an automated audit process. So that's where I see that coming into play. What was the second part of your question again?
Just how do we make that financially viable? And coming at it from the math and computer science point of view, got it, right? Like that's, you know.
Yeah, super cool.
Yeah, no question. But how do we make this work economically?
Well, that might be one of the reasons why it doesn't exist yet, but also, I bet people would pay for that. Like, I know that if you were a bank and you wanted to do something smart contract-wise, it is infinite liability for you to be putting money into that smart contract, whereas if you can do a formal verification that that is an unhackable contract, right, all the banks will come and do business with you. I think if you could make a formal verifiable contract that does, I don't know, tri-party through your bank, right, you would get all of the bank's businesses.
Yeah, maybe in the true DeFi model, you could actually have an insurance contract actually which got a treasury which will fund automatic verification audits. That could also be one economic way of doing it.
All right, we're coming up on time. So Prakash, Arun, any parting thoughts before we hop off?
Thank you, guys, and having us here. And
Yeah.
it's a pleasure.
Yeah, thanks everyone. I'll just leave one parting thought. I think sometimes crypto gets a bad rap in the media due to speculation, meme coins, and all that crazy stuff. I think it's this group right here that's actually reverse degenning the entire industry, meaning there's nothing speculative about treasury bonds, there's nothing speculative or meme coin about 5.3% yield on treasury tokenized funds. So I'm really excited to clean up the space and bring real utility to the people.
Fantastic. And with that, we'll be closing out this panel. Please give a round of applause to our fantastic panel here. All right, we'll shortly be transitioning to a keynote with Pat O'Meara from Invenium.
hear me? Can you hear me? No? No? It's not working? Hello, hello? All right, you can hear me. All right, well, we appreciate the brave, the few who have stayed to the end. Good to see you. My name's Pat O'Meara, and I was told that there is no introduction. I'm just supposed to stand up here and start speaking. So here it is. And my topic is real-world assets and tokenization of them, and what do we mean by that? And I'm the chairman and CEO of Invenium Capital Partners. It's great to be with you. And the first thing that I want to do is I want to talk about the fact that we need to speak with precision, because people are using terms all the time in really incorrect ways where you can have two completely different functions or meanings of using the same term when you're speaking. And I want to distinguish what we mean when we're talking about real-world assets trading, because I think there's kind of 5 different things that people talk about, right? Real-world assets trading in a tokenized form can mean the first distinction that you make is, are you pulling data from a referenceable database of something that exists with ready available data for it? So a tokenized treasury or a tokenized share of Apple. All of that data is sitting in a database, easy to see, and you're tokenizing that and you're trading it, and that's an easy thing to have, right? Tokenized treasury, money market funds, et cetera. So when you think about that, that is one flavor of tokenized real-world assets. Then there's another flavor of real-world assets where you're pulling data from the edge where the data does not sit in a database, right? So that is a centralized database. So it's not an Emma, it's not an Edgar, et cetera. And what we're talking about there is tokenized treasuries, or not tokenized treasuries, excuse me, tokenized alternatives, real world assets. And that's where we're talking about things like real estate, and we're talking about private credit and private equity and infrastructure. And we're talking about them where we're talking about funds and where we're talking about the capital stack of individual assets. And each of these have nuances that matter, right? And I think that anybody who is not speaking with precision when we're talking about what we mean when we say we're going to trade real world assets, that you can slip into the platitude and the meaningless really quickly. Do you know what I mean? And so what we need to do is talk about in Invenium, we're focused on trading of data-rich, low-frequency trading assets where data exists at the edge and it's not in one centralized database. And as we think about the trading of private credit, private equity, real estate, infrastructure, we need to think about this in a tokenized form where there's a decentralized marketplace per se. And I want to talk about 3 things. A decentralized ledger presumes in a decentralized marketplace that there's also compute. And that compute needs to be decentralized as well. And we're going to talk about what we mean by that. And then we're going to talk about data. And if you centralize any of those 3 functions, if you centralize the ledger, you're going to have intermediaries who are rent seekers who are going to charge you money for it. And the whole promise of a decentralized marketplace will not come about, right? Compute. If all compute has to be confined to one location or one function, again, there's going to be a centralization, and the promise of a decentralized marketplace will not happen. And that's the same thing with data. And so what we want to talk about is, what does a truly decentralized marketplace mean when we have data, compute, and ledger functioning at the highest possible manner in a fully decentralized way? And I want to start by talking about the difference between private markets and public markets, where we're just talking about compute. Because in public markets, it really is a centralized ledger. We know that, right? The advantage of the centralized ledger and a centralized data repository, Edgar, is that compute can be pushed into that data set at scale, right? High frequency trading, compute, brings enormous liquidity, and some could even argue that there's been too much compute put into the public markets. Does that make sense? Because what it does, it will actually swing the market beyond the fundamentals of the underlying. Does that make sense? Where it's utilizing the data. Now, when we have compute that's going to be pushing at scale into other markets, like private markets, that's when we're going to see in the early years the real benefits of enhanced liquidity by improved data. And then we're going to see this illiquidity premium be distinguished from a discount for lack of marketable information, right? Because many times there's two things that are in play, right? When we're talking about illiquid assets trading, and there's an illiquidity premium or discount. And what we do there is we say in many times that there's an illiquidity discount, and what is really at play is a discount for a lack of marketable information. Does that make sense? We conflate the two, and we talk about that all the time. There's not very good data, and we call that an illiquidity premium. Those are two different things. And what we need to do is begin to understand the distinction between those. And so Invenium is this connective tissue between data at the edge, compute, and ledger, right? And we know we're not going to go from a fully centralized world to a decentralized world overnight. But the movement to decentralization is happening in each and every one of these sectors. And let's just talk about compute broadly. And I know that there's some people in computer science who hate when I just talk about compute broadly, but remember where I was criticizing other people for imprecise language? I'm going to use that as a crutch right now, right? And so compute, when we talk about decentralization, the movement to the cloud is a first fundamental movement of compute being decentralized, as well as SaaS. And any kind of thin function where you have massive compute at the edge and you have a thin, meaning the compute is not on your laptop, right? And you've got a thin device that you're reaching into compute at the edge or in a centralized repository. That is a move to a decentralized compute functionality. So SaaS, as an entire industry and model, has pushed us there. And what I want to talk about is we are seeing massive evolution in compute right now, in AI, in machine language, in robotic process automation, right? So those three things are there, and it's going to bring an enormous amount of compute functionality to private markets. But if it doesn't have attributable data and data that you can actually audit and see where it came from, it's meaningless. Does that make sense? Now, the next step is, what is that thing that it's informing? And it could inform a financial instrument on a centralized ledger, that's for sure, right? But if it's informing a financial instrument on a decentralized ledger that allows an instrument that represents a piece of the equity of a multifamily housing portfolio, and you have the ability to real-time process that data, pull that data, compare that data so you can price the gross asset value of the asset, you can run a waterfall, you can figure out a carry calculation, then you can price the capital stack. If I can store that value in the piece of the capital stack and in real time understand its value and allow it to trade 15 minutes a day or once a week or once a month instead of once every 7 years, suddenly what I'm doing is I'm dramatically changing the discount for a lack of marketable information. And there's a bunch of people who've written many, many great papers on this, right? Nobel Prizes have been won as they dive into understanding this. And the example that I'm going to give is discount for lack of marketable information is if I own a building in Manhattan on 5th Avenue and I don't have good information on that building, because it's within a robust market, there might be a 5 to 10% denigration of the value of that asset. Does that make sense? But if I own an asset in Kuala Lumpur and I can't prove the performance data of that asset, nobody will bid on it. Does that make sense? The market, the broader market for that geography is limited enough that the discount for lack of marketable information is huge. And what we see in real estate right now, and we see in private equity, and we see in private credit, and in infrastructure, we could talk about that at length, is the longest part of the trade, and I got this from Albert, a great analogy, the longest part of the trade is always the denominator for the speed of a transaction, right? So figure out what all the steps are. What is the hardest one? That will forever and always denominate the speed by which that asset class trades. Does that make sense? And in real estate, what is the number one item that slows down a trade? Diligence. Does that make sense? You want to know the state of your asset. Same thing with infrastructure. Same thing with private equity. And to a degree, private credit. And we'll talk about that more in a minute. And what we need to do as we think about real world assets trading, meaning the alternatives markets trading, if we can begin to have mechanisms where we're looking to the edge, data at the edge, it's sitting in the systems in which the data is collected and sits at rest. And we begin to periodically look at that. So through Invenium, we've got about $70 billion of assets that we look and we, every night at midnight, ping and look at the state of their data. And if there's any change of state in data, what we do is we kick off a workflow. That ability to surveil data at the edge, the way we do it is we run a SHA-256, an algorithm, and we put a hash in the payload of a block, and we're on 13 chains, and another couple of sprints will be on our 14th chain, and we put that in the payload of a block. And then what we do is, every time we go in at midnight, we run that SHA-256, and if they match, we know there's no change of state. If it doesn't match, we know that something's changed. And then we can kick off a workflow. And what we're doing is we're using that as a thumbprint and a timestamp, because as we go into the future and we think about smart contracts that are going to begin to automate things like capital calls and distributions. If you have a capital call or a distribution and you actually move value on an automated basis, the only guarantee you have in life is that there will be a lawsuit at some point. Does that make sense? Like somebody's going to sue someone, and the question is going to be, what was the state of data that fed this automatic computation 3 years ago? And if you cannot prove the state of data that fed that, you can't automate the process. Does that make sense? You cannot. You're going to have a human, 4 eyes, kind of check on that function, and then you're going to appeal to process instead of data. But if you can push a hash, a zero knowledge proof that's on chain, and say this is the state of data that fed this automated calculation, suddenly you're going to be able to in court prove this was the data that fed this computation. Does that make sense? But the question is, how do you look at this data at the edge? Because the reality is data is expanding at an exponential rate, right? So there's a group called Alpha 10X. I was reading their pitch deck yesterday, and Alpha 10X, in this kind of newest fund that they're doing, they had a stat. I have no idea if it's true or not, but it caught my eye. It said that by Q4 2025, there will be 500% of the data available as there is today. I don't know if it's 500%, but it's going to be a lot more than it is today. Do you know what I mean? Every single time there's a new Tesla, you have something that's creating a terabyte of data a day. Every new Tesla that's going out in the world. Do you know what I mean? You look at NVIDIA, who's stamping out chips at scale. That's a whole bunch. And if we say that the prerequisite of private market assets trading digitally is that all their data is in one centralized database, we're creating a barrier that is impossible to achieve. So we have to do away with an architecture where we say we need centralized data and we need to go to a decentralized database. So we need to say, how can we trust the data and prove synchronicity of data that's being pulled from multiple systems and being pulled into compute on demand? That's a zero knowledge proof. That's being done today, and it can be done via surveillance. So the question then is, if we're able to pull data and serve as a browser of data systems, and pull data from many systems at once, and we're going to pull it into compute, where should that compute reside? Should that compute reside on chain, or should it reside off chain, right? And the more you embed compute unique to a single chain, the more tied you are to that chain. And if that chain goes down, you're out of luck. Does that make sense? You're making a bet on a unique chain, and in a multi-chain environment, you need to say, we can't do this. So what is the kind of logic that we want to use in order to determine what belongs on-chain and what belongs off-chain? And so the way we think about that is in symbolic logic, right? When you're having a discussion back and forth and you want to replicate that logical discourse on paper. In symbolic logic, they talk about 4 different things, right? Operations, constants, relationships, and variables. Everything in symbolic logic goes to those 4 things. And so if we think about compute, where we're actually processing data in order to come to an economic outcome, what of those 4 things should be on-chain and what should be off-chain? What should be on-chain are relationships and variables, right? This is a variable, the number is 3, and if 3, then we distribute money to this person, and then the relationship is it goes to here. If the number is 2, it goes to this one. Relationships and variables. Does that make sense? Operations and constants, if you embed operations and constants, you damn yourself to a reliance on a chain that if that chain does not win, you lose. You're making a bet on a primacy of a chain that can cause you a reliance that you don't want to have. So if you can put operations and constants, and what do I mean by operations and what do I mean by constants, right? So a constant is a calculation that you're going to use on a consistent basis again and again. So let's say we're going to have automatic market making for real estate. So we need an automated valuation model. So we're going to use a Cushman model, or we're going to use a JLL model, or we're going to use a Houlihan-Lokey model for private equity. That would be a constant, but you want to do that calculation not on-chain. You want to do that off-chain to feed a variable. Does that make sense in a smart contract? An operation is how you go through the steps that you do pre-trade, post-trade to service a digital instrument. Does that make sense? And that should be off-chain as well. And this is also, because right now in AI, there's a big thing, right? AI can process everything better, trust the AI. And we're still in the honeymoon phase, so we love everything about AI. Do you know what I mean? But the reality is, different people have different processes for reasons, and you don't necessarily want to trust the AI process to be smarter than the process that your business has built over 20, 30, 100, 200 years, right, in order to service these instruments. AI really becomes valuable when it helps you run your process better than you trusting it to run its own process. And what do I mean by that? How do you ingest data? What is the custody of data? How do you validate that data? How do you transmit that data? How does that what are the KPIs that matter the most? Do you know what I mean? And this is where all of a sudden we're beginning to use AI to empower a process that used to be human that we can now automate. So let me give you an example. There is a public company that we did a POC with. They administer the data on about $1.3 trillion of real estate, and they do that on a quarterly basis. They put about $13 billion of real estate onto our platform in order to do a POC just to see how quickly we could process it. As they did that, and this is a very centralized company, right? Their CTO famously said to me, I've mentioned this on a podcast before, that if I'm going to do any process repeatedly, I want to begin with a green screen. Right? And I laughed out loud when he said that, right? I thought he was joking, right? Like, oh, you know, ha ha ha. And this is a CTO of a publicly traded company. And then I realized he was serious, right? He wanted to begin with a green screen. And for those of you who don't know what a green screen is, that is a screen that connects you directly to a mainframe, right? So that's pre-cloud, pre-SaaS. He's talking about state-of-the-art 1984 technology. And this is the CTO of a publicly traded company. He said, if I want to do any process repeatedly, in no way, shape, or form am I going to do anything except on my machine on something that I code myself. That's insane. Do you know what I mean? Like, there's so many things wrong with that. But we took their 13 billion of assets on our platform, and in order to process a new valuation every quarter for that 13 billion, they processed 12,000 data points. And they used it all using people in India doing 10-finger automation, looking at emails that were sent to them in a bilateral manner. The most speedy processor of that data could do 10 data points a minute. And that was when they saw an email that they'd seen 9 times before and they just saw the 10th. Does that make sense? And then they 10-finger automated that into an Excel spreadsheet. Using our tool that we plugged in another AI mechanism, it went from 10 to 40 to 200, and our next iteration is 400 data points a minute. And that person ceased being a 10-finger automator, and you know what they were? A QA function, right? They were actually using their brain and saying, here's what we're gonna do. And Invenium, our software, is in no way, shape, or form smart enough to take data and understand what are the data points that matter and do that. But you know who is? Anthropic. You know who is? IBM Watson X. You know who is? Inception, Microsoft, OpenAI. They're doing all of this, but they're moving at the speed of light, right? Invenium is the airbag for that Ferrari, right? We force them to say, I only process data from something that I can validate a hash on chain. So it has to slow down in order to make sure we only looked at validated, most frequent data that's being used from what's at the edge. And then we force it to give attribution to the exact spot in the document that it delivers. Why does that matter? Because what is the biggest obstacle for big compute being used in private markets? Data sits all over the place. Nobody has the ability to aggregate it, and if you do, the way you gain an economic advantage of it is you use it on the benefit of your own LPs. Does that make sense? So Collar Capital, they spend $100 million a year just aggregating data on secondary trades of private equity interests so that they have faster, better data than anybody else so they can trade on it. So if I own a piece of Sequoia 7 and I want to sell it before anybody else, I can either go hire Evercore, they'll underwrite the whole thing, do a process, and in the end, 120 to 180 days later, I'll have a bid. Collar will give me a price the next day, right? And so what happens in moments of illiquidity? Who do people go to? Collar Capital, right? Where they can do this. What happens if we no longer need a centralized database that they're spending $100 million of their own money in order to create an economic advantage for their own LPs, but we had a distributed data environment that asset owners, through a tool like Invenium, can put Anthropic to work to extract all the data elements, structure it, and deliver it to comparative analysis tools real time. Sam Altman with OpenAI, every one of his large language models is run on a tool called Inception. Inception is owned by G42. Inception was created by a $14 billion investment by Microsoft, a $22 billion investment from G42, and an $800 million investment from Silver Lake. It is processing power at scale. One of the largest buyers of NVIDIA chips in the world. And oh, by the way, when they couldn't get enough NVIDIA chips, you know what they did? They spent $8 billion, one of the parents, G42, spent $8 billion to buy NVIDIA's main supplier of one of their components in order to have leverage so they could get more output. Does that make sense? So this is massive compute. But if we can't give data to it, it doesn't matter. And the reality is blockchain connected to AI, an airbag on a Ferrari is really valuable if you get into a crash. An airbag on a buggy where somebody's doing 10-finger automation just doesn't matter, right? You don't need an airbag on a buggy. Administration of alts, what we refer to as real-world assets when we're talking about that are going to trade on chain. We need to understand the state of the asset, but that data is everywhere. So if we can have a browser, a decentralized data architecture where we can look in on a permissioned basis, have AI, ML, RPA tools, look at it repeatedly, that's RPA, machine language where we're processing the data, and AI understanding the quality and delivering it in a structured form into compute at scale, suddenly we have the ability to do things like price real estate assets at scale across the globe. Cushman & Wakefield is an investor in us. They're one of the largest appraisers in the world of assets. We don't think the next big step for real world assets is going to be trading the underlying or the primary issuance of new tokens that represent the equity in real estate. That could happen. It could also happen as funds. But we think the number one benefit that you're going to see is tokenization in order to validate data at scale in order to understand pricing and price discovery, which will drive better accounting treatment, better collateralization, then derivatives, and then post-derivatives, you're going to have the trading of the underlying and secondaries, and then primary issuance. But if you don't have good price discovery and accounting treatment, you're never going to get to secondary trading. Do you know what I mean? If you don't have price discovery in there. And so what Invenium's doing is, by the way, I had notes, but you can see I'm sticking to it. As we think about the ability for blockchain to be a mechanism through zero-knowledge proofs of AI's ability to deliver compute to data that sits all at the edge to inform an instrument of the real value of the pieces of the capital stack, it explodes the opportunity of what's really available in the markets. And you say, well, what retail investor is going to benefit from this? They're not for at least a decade. But what institutional investors are going to benefit from this? A lot. I'll use an example. CPP, Canadian Pension Plan, buys a ton of data, and they try to recreate the CPI index every single period that it's announced ahead of it. And you know what they do? They trade ahead of it. They buy the raw data, process it, and then they trade ahead of it in order to outperform. And they try to recreate CPI. You have people like, I'm going to use Saudi Aramco, Mubadala, the PIF, who are gathering enormous amounts of data. They're pushing it at compute, looking for insights so they can trade ahead of it. There's a very famous, in one of our podcasts, we talked about this 2 weeks ago, where a private equity player was looking at trends, and they typically had a 1-year free look at where everything was going before their competitors began to see the sectors that came in. Because what they were doing is they were processing the data signals of what people were paying attention to and beginning to look at. And this ability to gain insight into massive amounts of data, when we can all of a sudden start to do it against an asset class, let's use real estate, is going to explode that asset class. How will it explode it? If we can price real-time real estate assets with attribution through automated valuation models and third-party marks once a month and AVMs in between, and all of a sudden we have good pricing, this creates enormous opportunities for people to create economic thesis that they can articulate in a trade well. Right now, if you have an economic thesis about real estate that you want to articulate, you have to do it through either owning the underlying or you have to own a REIT. A REIT is a super messy thing, right? That same REIT will own a cell tower, which is a fixed asset with a long-term contract, and you'll own a piece of retail in the exact same REIT, which is completely susceptible to consumer spending. Two completely uncorrelated, unrelated types of assets that are in the same thing. And oh, by the way, you've got geographic messiness because these REITs just buy what was for sale when they could do it. Now, you have people who say, I've got a much more focused REIT. Those REITs, by definition, are not good, clean mechanisms to articulate an economic thesis. But what if we can take all of the real estate data? So one of the things Invenium is doing right now is we're working with we have one of our largest user of our software is one of the big sovereign wealth funds, and then one of these big AI companies and a couple financial intermediaries. We are working to create the world's first derivatives exchange for real estate. And we're doing it because we have the ability to get critical mass on north of $1 trillion of real estate where we got pricing data. As real estate owners say we want to opt in to allow our building to be valued, we still control the data, it's not lost to a centralized database so they can pimp it out to somebody else. I can create indices. Those indices you can trade against. And what happens is if you own an underlying of a bunch of REITs, or you have your own real estate portfolio, but you want to hedge out a risk, you're going to be able to say, I'm going to do this through shorting New York real estate and going long Miami real estate, right? Or you want whatever the trade might be, right, that you want to do in order to articulate where you think the real estate world is going. Now, a lot of people say this is going to happen through tokenization of the underlying. We think that'll happen, but it'll happen in 5 years. Because the tokenization of the underlying is one building at a time, changing their legal structure, tokenizing those assets, putting them on the market for secondary markets, and all of a sudden then you get trading, and that trading is going to be a very accurate form of price discovery. But before that, if we can accurately get good data that's fully attributable, that we're using these new machine learning, RPA, and AI tools to extract data at the edge, deliver it in a manner that compute can process, we can create these indices. Suddenly we have the ability to create indices, and then from there, the ability to create mechanisms and puts and calls, and the ability to create all sorts of derivatives, repo markets for lending against private credit because we understand the collateral. And this starts just to open the door. It's the next step. Now, then what happens if we have these indices and people begin putting these tokens into for the equity, let's say, of a building, and that equity of a building, if it's a large enough asset or a large enough asset pool, suddenly we put that into an AMM. And for full disclosure, Invenium, we own 65% of a company creating AMMs for real world assets. If you do that and there's a third party setting the mid, and you have an AMM function for these things and they're trading, and IX Swap in Singapore has 6 of these that are live. The 7th one might have already gone live, but they're live. If you have real estate trading live every day, even if it's using an AMM, and you have attributable data that's trackable and logged, you've just met the definition for moving a real estate asset from level 3 to level 1. Forget level 2, which is what Invenium was preaching forever. We're moving a level 3 asset from an accounting treatment to a level 1. What does that do for an insurance company? That completely changes its capital charge. What does that do for a bank? That completely changes how much they have to reserve against those assets because they can see what's in there. Now, are 7 data points enough to go from level 3 to level 1? Probably not. But it's probably about 100. And once that happens, Deloitte will easily say, if you've tokenized a piece of your real estate or a piece of your portfolio and put it into an AMM and it's trading with daily subscriptions and weekly redemptions, that is a level 1 asset. That's going to explode and drive what people are going to do. And this is where we think data and price discovery will drive tokenization. Does that make sense? And it is the interplay of not one new technology. The market advance is going to come because we are connecting the value of a decentralized ledger with instruments that can trade in an AMM function connected to compute innovation in the form of AI that can reach into a decentralized data environment and pull it, and they don't need it all in one database. That was not possible 3 years ago. Full stop. It was not possible 3 years ago. It's possible today. That's amazing, right? And as we start thinking about what is going to happen, where you have AI with attribution able to deliver information to compute at scale. Imagine that you have a real estate asset, and there's a large enough of a data pool that you have a computer, and in this case we're going to use Inception AI, Inception from G42, that can say these are the top 85 comps for your large asset, not in your MSA. That would be pretty crazy, wouldn't it? Anybody who's ever looked at an appraisal for real estate, what do? You get 6 to 8 comps in your own geography. But what happens if all of a sudden, for this large asset, it says, this is the top comp in Kuala Lumpur. This is the top comp for that in Riyadh. This is the top comp for that in Sao Paulo. This is the top comp for that in Sydney. This is the top comp for that in Topeka, Kansas. All of a sudden, you have global financial players that are able to relate and understand the asset better. Does that make sense? And all of a sudden, their ability to invest goes up at scale. This is the opportunity for tokenized real-world assets. And now people are going to say, well, can't you do all of this on a database? Sure you can. But that has nothing to do with the innovation of a decentralized economy where you onboard and create a decentralized mechanism of innovation that blockchain brought about to do away with rent seekers and bottlenecks and rather open the door to broad spread innovation and create real open free market competition for capital to be allocated where the greatest alpha is. Does that make sense? And it's a democratization of the creation of a free market system with data symmetry. Wow, that's pretty crazy, right? When there's data asymmetry, there's 2 things you can do. Leverage the data asymmetry for your own book, or compress the asymmetry and collect rents from everybody. That's what Invenium's trying to do, right? How do you compress data asymmetry, deliver it at scale to these big computers? And by the way, you have enormous amounts of money going into AI right now. Stupid amounts, right? Sam Altman said, I'm going to get in. I don't like, I don't want to continue to build chips in the fashion AI is being, pushed by NVIDIA into one type of chipset structure. I want to create my own chips. I need 130 billion to do so. That's a lot of startup capital for an idea. One entity said, we'll put up 80 billion. That's shocking, isn't it? Right? There is money flowing into big compute at scale. The airbag of blockchain and zero knowledge proof that Invenium is working on is to make sure that that compute is being pushed through a proof of process, through a process that people know and want to understand, and attribution of source data, so it's not hallucinating. As we can begin to grab that data from all over the world, deliver it to multiple compute functions, and then inform products like the capital stack of a portfolio. But as we're reprocessing the gross asset value of the asset, the waterfall, the carry calculation, and then running the waterfall, and every day there's a new price being set on an automated basis, that also has a tangential effect of repricing the GP's carry every day. Do you think those will be traded? Like all of the type of data that this is going to create. Private assets are going to go to become interval funds at scale, and you don't just need to be Blackstone to create one. Do you know what I mean? You're going to have third-party oracles who are going to be coming in saying, yep, I agree with these values. I'm putting this as a constant, my model up here. I'm using the Cushman & Wakefield model, the JLL model, right? Or a Green Street's AVM. And then GPs are going to say, we're going to get these 3 things. We're going to run them through the big compute. They're going to price this. We're going to have daily subscriptions, weekly redemptions. And then one of our partners is MasterCard. Literally, you're going to be able to put that multifamily housing portfolio in a tokenized form, and I'm going to be able to buy my latte with a MasterCard that's going to liquidate on a weekly basis. So I got a credit line for a percentage of the face. And if I can do that, why am I doing direct deposit of my paycheck into a bank? Like, why would I do that? Why wouldn't I do a direct deposit of my paycheck directly into a tokenized asset that increases in value and cannot be deflated, right? That's when banking gets rethought. And this is the tokenization of real world assets. When we tie together data at the edge, compute at scale, and a ledger, and to the degree that all three are decentralized, you're gonna have the greatest opportunity for the spark of massive innovation and the viral effect we all want to achieve. Does that make sense? And it is not one single technology, it's three different pieces being tied together. The ability to use decentralized data to inform compute. Compute's innovation in AI that's been blowing up the last 5 years, really the last 2 years that caught the public imagination. And then lastly, this decentralized ledger. Those instruments on the ledger, and this is what we think will happen, is, we're working on this, the world's first derivatives marketplace for real estate. That alone will transform how real estate is done in the world. This is the exact opposite of tokenizing the dollar and the treasury. Do you know what I mean? Which I'm not denigrating at all. It's just starting from a completely different place. All the data is referenceable, it's easy, it's tokenized, and really the problems I'm solving are around wallet and AML and KYC. Versus the other side, we're only dealing with QIBs, qualified institutional buyers, large institutions. We're solving data, price discovery, and discounts for lack of marketable information. And once that happens, we're going to start to see, with perfection of data, what the illiquidity premium really is. And if we can start to begin to erode that through AMM, man, that's really exciting. So we think this is the future of real world assets, and it's not blockchain. It is blockchain plus data at the edge, plus big compute being delivered on demand. And that big compute needs to be disconnected from the core of the ledger because we're going to live in a multi-chain world. Why don't I pause there, and I have one last thing that I want to do. But any questions, any comments, and I'm sorry that I just ranted for like 40 minutes. Yes, sir.
Is your end market goal to create a more transparent product for an liquid asset that does not trade on a daily, weekly, seconds basis?
Yes, but I'm going to sharpen the pencil just a little bit, right? It's providing data symmetry so that price discovery can be observable and the relationship or correlation of assets to each other can be made possible across many markets. Because for many of these illiquid assets, the markets are silos. And one of the big goals of what we're trying to do in a decentralized environment is to aggregate liquidity across silos. And there's money in Topeka, Kansas, and there's money in Oshkosh, Wisconsin, and there's money in New York for sure, right? And there's money in Miami. But the reality is, particularly in real estate, a very local thing, the ability to aggregate that, if you're not huge, is very difficult, right? And so what we're trying to do is create that symmetry so that capital can flow more easily to.
So you get the price of call it real estate in all these different cities, right? And then you sell that data
So the markets, and so one of the things is the asset owner, Invenium is a tool by which the asset owner can make their assets data known to compute. They get to feed their data to whatever compute they want. So you don't need to be US Bank to use Anthropic. You can be a mid-sized real estate developer, right? And all of a sudden you're using all sorts of really cool compute, and then you're tokenizing it, and people can trust that data using the blockchain and all of that sources. And then you're listing it on places like Rialto and Oasis Pro Markets and Archax and InvestaX and ADDX and SDAX, and then also at some point maybe uplisting into public. But it is the listing of private market assets on many, many, many different exchanges. And we think that a derivatives market is going to be the first thing that's going to develop for alts. Because the pricing data we're going to be able to deliver at scale. And then from there you can create indices. I have a big screen that's saying time's up, but we're going to ignore that. There you go, thanks. Yes, sir.
Yeah, so how do you incentivize owners to share data, right? Like GPs are very protective because they want to basically have their different narratives, right? You want to have your narrative with the city, in order to, create like a lower sort of tax basis. You want to have your, discussion with, potential LP, maybe your lenders. So like these are all different stories that are being told by the same general partner.
Yeah, super great question, right? How do you incentivize people to share their data? Right now, listen, we're going to stick in real estate, but we could go to private equity if we want, but we're going to stick in real estate just because we're going to stay on that theme. CoStar takes people's data against their wishes and pimps it, right? You know what I mean? And that's their business model, and everybody hates them, right? What this is doing is you're giving people the ability to own their own data and then opt in to an indices, right? And with what we're building two mechanisms of incentivization, right? One, to anchor your data on chain, right? And for doing so, there's an incentivization model for that, right? That as you do so, either your valuations are free, does that make sense? Or you participate. And then the other side of that is, as you begin to create this, you are, the indices that your building is in, you want that because A, any trading of that, you get some attribution, right? So you get paid. But B, a building that's in the New York 100 will trade more than the building that's 101. Does that make sense? And everybody's going to want to be in indices. Does that make sense? And so it is a mechanism but it is fundamentally an opt-in data marketplace. That's right, lower cap rates, better performance, secondary markets. It unlocks all of these other functions, right? The AMM interval funds that are not, that don't need University of California to come and bail them out, right, when they price it wrong. You're absolutely right, but the macro trend is at some point there's health benefits to beeswax candles, but at some point electricity will win, right? Like electricity will get, the whole island of Manhattan will one day have electricity in every building. I don't know when it will be, but it's coming, right? It's like betting against that macro trend, right? Transparency is coming, and you can elongate your business model, or you can pivot and say, I'm going to be somebody who's going to win in a more transparent marketplace. And I want to give you an example. Cushman & Wakefield, right? They're an investor in us. Whatever. Their market cap is $2.9 billion today. Moody's is $60 billion. Cushman wants to look more like Moody's, where they denominate and mark the value of assets, than to be a broker that's 100% transactional. Does that make sense? Because every time Moody's gets a new asset that they're starting to rate, What do they get? Fully recurring revenue. Their multiples are literally like 20x what Cushman's are. And so whether you're talking about S&P and IHS Markets or a Refinitiv, Moody's, JLL, and CBRE want to look like Refinitiv in the future, not reliving that transactional. And by the way, the firms whose senior leadership is perpetuating data arbitrage are going to be fighting against a tide. Does that make sense? And they're going to lose that battle. But that, very good point. Yes, sir. Did you have a, oh, yes, sir. No and no. Thank you. Yep, sorry. Has the data that Invenium is processing right now been used for a rating or for a securitization? No, but it has been used for a sale. And so they're a very large asset, call it worth, north of $1 billion, many, many different buildings, whatever, it was a portfolio. We were pricing it real time, and they put it up for sale, and it transacted an arm's length transaction between two semi-related sovereign entities at exactly the price that was set on a monthly basis. And literally it transferred, and that transfer happened at exactly that price. So we are right now primarily being used to mark people's books real time and provide price discovery. Does that make sense? And then now we're going into listing funds, facilitating marks for AMM and exchanges, literally building exchanges. I'm sorry for going on ad nauseum. It was a pleasure to be with you. Thank you guys all so much.
Wow, what a beautiful day of more tokenization knowledge. It was clear yesterday we learned from the blockchains, the builders, the tokenizers, that this is already happening. Today we learned from Wall Street, institutional finance, how they are reinventing their plumbing, how they're building a new operating system using tokenization, of course, for all of the benefits Pat very well just covered. Honestly, we could give him the stage all day and he could talk. He is very, very smart, probably the smartest guy on this topic. But now, for those of you who don't know, we are actually having a closing reception at around 6. The expo hall will be still available. And fun fact, we actually started this company in 2017, where we were advising a company exploring a tokenization of their private shares. And since then, we've actually consulted over 50 different clients across carbon credits, funds, real estate, equities, even blockchains and other infrastructure providers themselves. And we have an amazing workshop tomorrow from 9 to 3 that you can tune in for just the code UPGRADE. There's only a few slots left. Code UPGRADE. You can get the workshop for just $500, so I hope you can join us. We're going to be really diving into it with Peter, who you saw speak earlier today, as well as a few other guests. So thank you, everybody, for making this conference possible. We're going to do it again next year. I hope to see you all there and at the reception. Thank you, everybody.